Of kind of what we do is based on what happens with the chemical sector. And if they're seeing a pickup in demand or restocking, then that's an interesting story. So European markets are about to open. I would argue keep an eye on Infineon this morning, keep an eye on Rheinmetall this morning. The DAX may see a little bit of outperformance as a result of that. But European markets are opening ahead of key inflation data as well a little bit later on. So initially out of the gates, mixed performance coming through from the pharma sector. ASML's a little soft, not ASML, AstraZeneca, a little bit softer this morning. Luxury getting a nice bid though. LVMH is up, MS is also tracking higher as well. Novo, I think, is tracking higher too. So that's the lead. If you've got Novo up, that's a pretty positive sign.
Yeah, you've got some of the oil names outperforming in line with some of the macro trade that we're seeing in commodities as well. Your biggest index contributors this morning, Shell, BP, you've got Glencore in there as well. Alongside, by the way, I've got to talk about it, the banks. This is very similar to trade to what we saw yesterday as well, where banks and commodities are the leader. I think there's a macro piece of this as well, which is that the FTSE 100 hit those record highs yesterday. So traditionally, when you hit record highs, you expect a little bit of a pullback, maybe that weighing on the entire market this morning.
The core kind of growth story out of Europe is performing well this morning. So Novo Nordisk is up. ASML is tracking higher as well. SAP is doing well. Schneider Electric is on the list too. So you've got some of these key stocks, LVMH. So we talk about this kind of core European trade. A lot of those names are having a much better day today. As you say, the banks are also tracking a little bit higher too. We do have a little bit of weakness in Astra and a little bit of weakness in Unilever. That may weigh a little bit on what is happening in London. Diageo tracking a little lower as well. I just want to check out this Astra trade. We'll come back to that in just a moment.
Yeah, it's an interesting one as well, and I'm curious. I'm still waiting for some of the kind of chip makers to get a little bit more volume, and specifically Infineon is the one that I've got my eye on when I think the DAX opens in maybe two minutes or so.
Yeah, I think it's up. We haven't got a price on the DAX, but what we're looking for, I think, is a pickup in the chip sector this morning. So it looks like the DAX is now open. It's up by 0.2%. So the FTSE's lagging, given some of the heavyweights, that I think that is to be expected. But elsewhere in Europe, I think a mild, moderate tick up a little bit. I just want to see what's happening in the bond market, though.
Yeah, I was just about to
give us an idea as to what is happening there. Yields generally coming a little lower, but not by much. US yields just ticking a little bit higher once again.
You're starting to see that divergence again, and this is the part that I'm confused about, is how do you actually, what is the read-through there? Is this that divergent story that we're talking about in policy, where Europe is going to kind of start trading and doing its own thing in the bond market? Do you still have that same story of, if 5%, for example, is the Achilles heel for U.S. stocks, what is the boost on rate cuts, for example, or the yield move for European stocks at a time when the catch-up trade is so popular?
It's going to be really interesting to see how the curve kind of diverges here, or doesn't diverge. So potentially what you could see is front-end yields in the Eurozone coming down.
Yeah.
But the US 10-year, if we are going to track up towards 4.5, potentially 5, having such a big gravitational effect that actually longer-dated bonds here in Europe don't fall that much, and you end up with the kind of disinversion of the curve that we've a very kind of inverted curve right now. That disinversion, that could be really interesting in terms of the Eurozone bond market dynamic, and a completely different story than one we've had over the last 18 months.
So what matters more for European stocks from a macro perspective? Is it the commodity landscape, the oil read-through from the Middle East? Is it the FX story, euro-dollar weakness? Or is it what you're seeing in the bond market? What do you think is the biggest read-through?
I think earnings probably is going to be the biggest read-through. I think there's some big cyclical factors that I think are going to be interesting, and I think the kind of the catch-up trade with the States. There was an interesting piece out over the weekend as well, talking about the idea that hedge funds in the States are looking to Europe.
And they've already positioned for it. They're ahead of the game.
For that catch-up trade. So they're ahead of the game on that one. So I think there's a tactical kind of positioning element to what is happening here in Europe, but I think earnings are going to be really interesting as well. A lot of European companies, we just named some of the names, big global exposure. If the US economy continues to perform quite strongly, do those names continue to thrive in that kind of environment, potentially with the added tailwind of a cheaper euro, maybe giving them some advantage as well. So do you want to buy dollar earners in the kind of scenario that we're looking at? Europe slows down, US doesn't, rates differentials start to emerge. Do you buy the dollar earners out of Europe and position yourself that way rather than positioning for anything kind of directly associated with Europe?
The trade-off is interesting, right? Because do you, to your point, do it through the dollar earners, but when you are talking about the European exposure, is it a story of equities over bonds or bonds over equities? We actually spoke to Bana Baweja of UBS Investment Bank, I believe on Bloomberg Brief. Take a listen to his take on that trade-off.
We are very much bonds over equities across all regions, but particularly so in the U.S. We do think in the near term, the earnings picture for the U.S. market looks reasonably strong. And then, ironically, through the rest of the year, we are actually going to see tech earnings momentum come a little bit lower and it broaden out to the remaining parts of the market. Bonds should outperform equities over the next 12 months. And we feel that that's the case for the U.S. We do think that's the case for Europe.
Sophie Lund-Yates, lead equity analyst over at Hargreaves Lansdown, joins us this morning. Sophie, a pleasure to have you on the program. Let's talk about that read-through, though. The bond market into the equity market. We're talking about it a lot in terms of the United States. What does that dynamic look like here in Europe?
Hi, good morning. Yes, absolutely. I think really the biggest thing here is that I personally tend to agree with what you were just talking about there with that clip you were playing. What we are going to see is that, broadly speaking, the market momentum, as much as it's, I'm pretty upbeat about it for Europe overall, there's actually not a huge amount of catalyst for change that I see coming through in the immediate term for things to really be kind of shooting the lights out. Now, when we look at the bond volatility that we're seeing, particularly across the pond in the US, I do think absolutely a lot of that is going to be read across slightly in Europe, but more broadly speaking, as an asset class, I do think that they are potentially telling a more compelling story at the moment.
So then do you pay a little bit more attention to the currency weakness? For example, Guy was making the argument there that it's really a story of dollar earners. The European outperformers are those who have been relying on that U.S. consumer story. Is that the trade that continues for the next 12 months?
I definitely think there's an element of that, but I'm actually more kind of in the camp of looking at this through the lens of potentially a bit more old school, if you like. So looking at this through the lens of, okay, pure play speaking, who is positioned to do well in this environment? And Europe is actually really home to some very specialized, maybe not quite as exciting stories. You know, I think you look at names like defense, telecoms, and some of the UK financials, some very compelling yields and valuations, to be frank about it as well. So for me, it's kind of coming back to basics and looking at those wide economic moats, looking as well, I think a metric that has been a little bit, I'd call it, underappreciated at the moment would be those dividend payout ratios. A lot of those haven't actually fully recovered from pre-pandemic levels. We're seeing a lot of caution, and that means that actually yields are looking a little bit more protected than potentially they have been in the past. So these are all elements as well that I'm considering.
Sophie, you're making Pretty's day talking about the dividend story. Fundamental analysis. Is it really worth pursuing at the moment? Like, in theory, it should be, and we've all been taught how to do it. But is it something that is actually having a big impact in these markets at the moment, which in certain areas feel very speculative, but that's where the momentum is? Can I avoid that momentum? How do I think about momentum versus speculation?
Sure, this is such an important topic, and the way that I look at it and the way that we certainly talk about it at HL is the fact that, okay, do not ignore these mega trends. Do not ignore AI. Do not ignore the huge excitement around cloud. But concentration risk, lack of diversification in any sense is never a good idea. And actually bringing it back to basics and making sure that actually you have paid attention to things like, and I know it's things that people don't like talking about, but actually considering things like balance sheet strength, bringing it back to financials again, for example, the banks are arguably overcapitalized at the moment. That caution that we've seen is really going to be paying dividends, literally, not to go on about that too much, but looking at those companies where there is exposure to this really exciting new world of tech and AI, but actually, what is the free cash flow generator of that business? Do they have a proven track record of margin accretion even in tough times? These things absolutely do still matter.
Does that take me to the FTSE 100? It's interesting as well. We've got a commodity story that's beginning to develop too. There's been a lot of talk about the fact that it is super cheap versus the rest of the equity universe. Where are you looking for the greatest kind of bang for your buck, as it were, if you are going to pursue that idea that we need to be looking at balance sheets, that we need to be looking at dividend payouts? Where is the most obvious place to look first?
Yeah, sure. So, of course, the elephant in the room, one of the reasons that the UK is not getting a lot of love is because we are in a very difficult position, right? The GDP, the growth trajectory story is very challenging. However, there are some corners of the market that absolutely, in my opinion, have been massively over punished. And I do think that the financials is one of those areas, particularly some of our more bread and butter banks, so those not necessarily engaged with the more volatile activities of investment banking, for example, actually have some pretty compelling propositions at very reasonable valuations. A lot of them, they're trading for under the value of their assets. They are below book, and also those payouts are really quite compelling, particularly when you look at the buyback activity that's been happening. And those CET1 ratios, that core measure of capitalization, are really, really fundamentally strong. Arguably too much, and we could be seeing them doing a little bit more with that money. But when you're looking at that through the dividend lens, it's really quite an interesting story.
I want to bring it back to one of the other sectors we were talking about earlier, the energy story. Even in today's trade and yesterday's trade, we see BP, Shell, Glencore at least leading some of the opening ticks. As we monitor oil prices hitting potentially $90 a barrel on Brent crude, potentially 100, that seems to be somewhere where the positioning is headed. Does higher oil prices, or do higher oil prices today, does $100 a barrel pose the same risks to UK equities, European equities, that it might to some of the US counterparts?
Sure. So I do think that looking at $100 a barrel, as much as we're hoping it doesn't reach that point again, it's not completely off the cards. We've seen the level of volatility and disruption that's been happening lately on the macro level. Now, obviously, on one sense, this massively helps prop up the FTSE because we have those oil giants. But at the same time, as you're alluding to there, is what does that mean? What's the read across there for the inflation print? Now, more broadly speaking, the thing with that is what we need to remember is that oil prices are cyclical. They bounce around all the time. They spike and they drop, and that is a cycle that is never going to change. So it's more about looking at the picture of what can you do to help position yourself for that. Now, for the while, I do think that we're going to be seeing elevated oil prices for some time, and that obviously has positive implications for big parts of the UK market. But the main message is that volatility is what's expected. So what can people be doing to position themselves for that more specifically?
Okay, well, you tell us. What can they be doing? Is it as simple as buying a basket of commodities, or if you don't want the exposure to the volatility there, a basket of miners, a basket of your Shells, your BPs, et cetera? What's the trade?
Sure. So I think there are some very interesting plays in the energy market more broadly at the moment. And you look over in Canada, for example, the likes of Cameco. What's going on with nuclear at the moment? Because we do know that when you zoom out of all of this volatility, the longer term play here is looking for solutions to the energy problem. And I think that when you look at the uranium supply demand dynamics at the moment, some really interesting things going on there that I think can be pretty compelling. And I do also think, again, it's just coming back to that point of do not be over-concentrated in one particular area of the market. Just because oil prices are high right now and you think the majors are going to benefit, that does not mean over-egging that. And I do think, the likes of the nuclear plays, we have the likes of Rolls-Royce as well playing into that in a slightly separate area of the market when it comes to nuclear, I think is worthy of a lot of attention.
Great to catch up, Sophie. Thank you very much indeed for joining us. Sophie Lund-Yates, lead equity analyst, joining us from Hargreaves Lansdown. Thank you very much indeed. Let's continue the conversation around equities, the core six around Europe. Look a little bit like this morning. You are seeing a bid coming into Novo Nordisk and LVMH this morning. The Novo bid is quite strong. That's interesting. So that stock pushing European equities higher. ASML, I think there's a huge read across from what we've seen in terms of the story developing in Taiwan. TSMC having to shut down some facilities as a result of the quake a little bit earlier. You are seeing Infineon tracking higher on an upgrade. Schneider, this is another AI play that is up this morning. Nestle is adding the most points on the downside, which is interesting, out of Europe this morning. And Ferrari, I'm not sure Ferrari's really anything to do with Tesla this morning, but that stock giving back a little bit of ground as well. Let's talk some of the individual stocks that we should be focusing outside of the core six. Here's Joe with those movers.
So we'll take a look at the stocks that have M&A news out today. We mentioned Genmab earlier doing a $1.8 billion deal for a rival cancer drug over in the US. That stock was up around 1% in Copenhagen at the open, coming down a little bit now. It does need a boost. That stock has underperformed significantly over the past year. But the one I want to bring you to is Renishaw here in London. Now, this is actually an Apple supplier. They make machinery that is used by Apple to construct their iPhones and other products as well. Now, yesterday we saw a blog post saying that they could be a potential bidder target from Siemens, but Siemens giving a statement today saying they will not be bidding for Renishaw, and we're seeing the stock giving up pretty much all of those gains at the moment, down 4% now, was down around 6% earlier today. In terms of Richemont, we had news in the Financial Times potentially going to find a bidder for their Yoox Net-a-Porter online clothing website, and that stock slightly higher but pretty much in line with peers. And we also had Sika over in Switzerland as well, doing a deal in the US for a rival maker of appliances in the construction sector. So all of those getting some M&A news today. But we'll take a look at those chip stocks. You did mention the read-through from Taiwan Semi potentially having an impact as well. We also had Intel overnight. They had a weak report out on their chip business, their foundry business. They've recently started reporting on that, and we saw Intel down as much as 4%. So there's a lot going on today. And you also did mention a couple of broker moves. We had Infineon getting an upgrade at Morgan Stanley and Soitec a downgrade at MS. They switched their preferences there, but a lot going on. The focus on Taiwan Semi, and the shutdowns of some of those plants. So we are seeing a few gainers, and also Soitec coming down in the chip space today. Then in terms of Swiss Re, we did see this one declining. It's shock news of the CEO standing down after 8 years. So we are seeing that stock coming down 1%. It has rebounded to pre-COVID levels recently in terms of Swiss Re's own share price. Then just a small one in the UK. We've got a little profit warning out of Topps Tiles, warning that fewer people entering their stores in Britain, fewer people interested in doing DIY, perhaps a good reader on the UK economy, one we tend to keep an eye on. But that is down in the small cap space. We're seeing it down around 3% this morning. Then a couple of broker moves to bring you the best performing stock on the Stock 600 today is Fineco Bank. This one is due to an upgrade over at JP Morgan, which likes the Italian lender's asset management business. They say it's rebounding, and there's not a better stock on the Stock 600 this morning. They're overweight at JPM, and it's 16.30 euros a share. We can see trading at 14.16, some upside for that one. And I want to take you back to pharma, because we've got a very interesting one on Idorsia. Now, this actually makes an insomnia drug, quite a niche market in terms of what they're doing. But Morgan Stanley today saying that this stock is worth a single Swiss franc, according to those analysts. Now, around a year ago, it traded at 10 Swiss francs a piece. So we can see a very low price target for that one. It is actually coming up very slightly at the moment, but keep an eye on that one. That's Idorsia trading in Switzerland, slightly higher this morning.
All right, Joe Easton from our equities team walking us through some of the major movers that we need to keep an eye on. Guy, this is really interesting. We're watching a lot of these kind of analyst upgrades and downgrades, moving the market more so than the macro is.
Yeah, so single stock certainly within the market moving around quite a lot. The Infineon news, I think, is certainly having a big effect in terms of what's happening with the chip space this morning. I think if you take a look broadly across what's happening with the kind of where the weight is this morning, though, it is on those stocks that have been doing well in Europe recently, and it's the ASMLs, it's the Novos, and I think that's interesting, and maybe that speaks to this idea of this catch-up trade. If you want to play the index, what do you and you see this catch-up trade potentially happening? Are those the kinds of stocks that ultimately you have to end up buying? If you're going to buy the index, that's going to give them a boost. If you want to kind of zoom in on maybe some of the stocks that have been having the biggest effect on the index, those are the kind of stocks that maybe you want to be watching out for. So maybe that is part of this catch-up trade that we're seeing here in Europe this morning.
You brought up earlier the companies that might be outperforming, might be popular with catch-up trade are the ones that are U.S. reliant. You brought up Novo Nordisk as well. I think in the last 24 hours, Costco, this major warehouse retailer in the States, do you have them here?
We do have them here.
Okay, never mind. So Costco signing on to offer Ozempic monthly, which I thought was a big deal. I mean, to really take in mass consumption.
Wow, but that just reinforces the idea that maybe Novo has a production problem, and that's the fight that it has right now. It's basically trying to get as much of this stuff out of the door as it possibly can. That's where the challenge continues to be for that business. It's very similar to what's happening with NVIDIA. Can we produce enough chips quickly enough to satisfy the market? It's a supply side story.
It very well may be. Let's see what else is a supply side story, because we'll see what is on the list of that catch-up trade in terms of the stocks to watch. Coming up, Bloomberg Intelligence has done the analysis. We're going to discuss what's on their list of things to keep an eye on. More on that story next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy, with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Welcome back. 22 minutes into the session. FTSE's down a bit. Rest of the market's kind of up a bit. I don't think we're going anywhere in a hurry, to be brutally honest. Keep an eye on what's happening with the bond market as well. That's certainly been the story over the last couple of days. We do have inflation data coming out a little bit later on from Europe. In terms of the 10-year, the US 10-year is ticking high. We're up by another 3 basis points. But here in Europe, it's more of a mixed picture. Germany's up a little bit. Italy's down a little bit. We're waiting for that data, which drops a little later on this morning.
10 a.m. UK time,
yep.
I believe. I'm still processing yesterday's data. It's all over the place.
Which data?
All of it.
The JOLTS data. The JOLTS data caught my eye, certainly.
Yeah.
Because it just again reinforces the idea that we're into a solid labour market, which takes us to the Friday payroll number, which we were talking about this earlier with Darren Captain. He thinks could be a really solid number, north of 200 once again.
Yeah, well, he said 240, and he said, what I thought was interesting is he called it kind of he still said it's post-pandemic normalization, which pre-pandemic 200 was way too much. That was a hot number. So I think that's interesting. And we even talk about what the read-through is into the bottom line of a lot of these companies, right? The bond market, the rate story, the yield story, commodities, et cetera. Wages probably on that as well.
Let's take us back to single stocks and ones we should be watching. So Bloomberg's list of 50 companies to watch in January, we've had that. Now we're whittling it down a little bit. We've got 10 more stocks for the second quarter based on scenarios that are coming out of Bloomberg Intelligence. Let's figure out which ones we should be watching and why they're important. Tim Craighead from BI joins us now. Let's talk about methodology first of all. Why are we... Why these 10 companies? Why are they so important?
So you mentioned the 50 for the year ahead. All of these 10 and the 50 are part of our focus ideas. Our focus ideas have 3 pillars. 1, high conviction fundamental view.
Yeah.
2, different from what the market thinks. So there's disconnect here that we see. And number 3, quite importantly, there are catalysts ahead that we think will bring the market around to our point of view if we're right. These 10 specifically have catalysts coming up in the second quarter, and that's why we've zeroed in on these.
Like what?
So we're here in Europe. 3 of the 10 are European. Standard Chartered, Pirelli, and Accor. So very different. These are across sectors. Standard Chartered, we think that they've pretty well done what they needed to do to take care of their Chinese property concerns. At the same time, we think the market doesn't quite get how good their wealth management business is growing, and they're also reducing costs. Pirelli, we all know the tire company. If you're an F1 fan, all the better. These guys are upgrading their mix. They're getting rid of some of their lower-end product. At the same time, they're moving their production facilities to lower-cost places like Romania or Mexico. Again, we think that there's upside to profit expectations. And lastly, Accor, it's a travel recovery story that we think continues to sustain, whether it's here in Europe or in Asia. We continue to see higher room prices. RevPAR for these guys is surprising.
Is this a buy list?
Well, we don't make recommendations per se, but these are, like I said, these are all calls that we have a really strong fundamental point of view that we think the market doesn't quite get.
Are there some companies where the market's being too optimistic?
Absolutely. So look at the flip side. 2 of these are concerns. They happen to be China-related. One is CSC Financial, which is one of the big Chinese brokerage companies. There we're seeing new listings, IPOs disappoint, part of it because of regulatory pressure and what have you. We think there's room for a miss here. The other is Chow Tai Fook, which is representative of a broader call that we have on Hong Kong retail, which we think is suffering from all of the woes going on there, whether it be property or otherwise. And also, Hong Kongers are actually going across the border and shopping more in mainland China. And it's creating a disappointment for Hong Kong retail.
All right, Tim Craighead from Bloomberg Intelligence, we thank you so much for bringing us that analysis. Coming up, we go to exactly what Tim was just talking about, China, and what the relationship with the United States might actually look like after Presidents Biden and Xi speak for the first time since November. More analysis ahead. This is Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Market Today. We're about 30 minutes into the European trading day. We've got a couple of single stock movers, some of the read-through coming in from Asia as well. But the big picture seems to be what's going on in geopolitics in the Middle East. What is the read-through there? What's happening in the States with Fed policy? And how does that all kind of fold into the inflationary picture around the world? At least that seems to be the narrative for me.
Geopolitics certainly playing a part. We're going to watch what's happened with Iran as well with the oil story.
Yeah.
Do we continue to see oil ticking higher? I think it's going to be one of the themes that the market is going to watch out for. A lot of Fed speak coming up later today. We've got the inflation data coming out of the Eurozone. Single stocks, though, I think are interesting in terms of what we are getting here today. There's some interesting upgrades and downgrades that I think is worth paying attention to. Elon Musk is on your radar.
Sadly.
He's on all our radar.
Yes, he's on everyone's radar.
Tesla yesterday.
You know, I was really hoping for a nice pivot there, and I guess I have to talk about this now. Elon Musk tweeting, or Xing, whatever, on his social media platform that he now owns, saying that he would buy Disney shares if Nelson Peltz was elected to the board. He says he doesn't own any Disney shares today. We know there is an ongoing vote. I think the last time I checked, Disney had like a 60% margin or something like that. But we know that this has been a big activist story. Nelson Peltz saying things need to be restructured. This has been ongoing even before Bob Iger retook the helm of the company. Now Elon Musk kind of throwing his weight behind Nelson Peltz.
Do you think he should be focusing maybe on other things?
I refuse to comment. I'm a journalist.
Okay. President Joe Biden, let's talk about what has been happening with the story around China. President Biden and his Chinese counterpart Xi Jinping speaking on the phone yesterday, their first one-to-one communication since November. They indicated in November when they had that meeting that they would try and talk more often, but it looks like this was carefully choreographed. Nothing really significant coming out of it. I think the objective, certainly in terms of the briefings that were done beforehand, was that this was not going to be a headline-generating event. But it comes at a time when we are seeing the U.S. administration reviewing its tariff policy. We're expecting maybe news on that. We also have the Treasury Secretary traveling to China later on this week. Janet Yellen will be there. What impact is she going to have, and will she take a tougher line? How should we look at this from a macro point of view, particularly also ahead of the U.S. election? Diana Choileva, Chief Economist at Enodo Economics, joins us now. Diana, good morning.
Good morning.
Nothing came out of this which I think is quite interesting. Tensions do seem to be rising between these two countries, and we do see this potential for higher tariffs coming out of the United States. In some ways, is no news good news?
Well, the good news is that they are talking. The bad news is that there is no change in terms of this all-encompassing great power competition that's about to heat up because, as you mentioned, the U.S. is going to have presidential elections. There is no way the Biden administration can afford to be softer on China, even on issues which ideally just purely on economic grounds they could revisit.
Do you think Biden's erring on the side of increasing the tariffs? Do you think that would be something that would work, A, economically, B, politically? Trump is certainly pushing that line at the moment.
It won't work economically unless the U.S. assembles a bloc of countries, like-minded countries, that apply the same pressure, because otherwise we're just seeing exports finding their way around and going via Mexico. So the tariffs are a particular issue, but are not necessarily working as well as they should. They're not really necessarily beneficial in stopping China. But what's really biting, and Biden has been very successful, is the tech restrictions.
I want to get to that in a moment. But first, when we talk about this kind of tariff policy as well, Bloomberg Economics as well did its own research. They said that in the long term, and just within 2 years, 60% tariffs plus 10% tariffs on other countries would ultimately create a contraction in the U.S. economy. What does the short-term benefit look like, though, in, say, within those 2 years? Is there a short-term benefit to tariffs?
Not really from a macroeconomic point of view, but from a geopolitical point of view, when both sides are really focused on national security and being prepared to forego the sort of benefits of the globalization we used to have, then they see these necessary costs having to be paid.
Right. And so you mentioned the geopolitics there. Let's fold that in with the economics when we come back about Taiwan, because this was something that did come up in the call between the two presidents. What's the read-through there? This morning we're getting headlines out of Taiwan in terms of TSMC and the read-through there, the earthquake, that of course we're still monitoring the destruction and headlines there. But in terms of the tech read-through globally, the message has been that there has slight disruptions for TSMC, but perhaps not global, broader ramifications. What might a tougher stance on Taiwan from either side have for the global economy?
Obviously, it's not going to be good news. Really, I mean, the risk of conflict over Taiwan at the moment, i.e. up until the elections, of an actual invasion or military move that could be interpreted as crossing the red lines is unlikely. But the risk of accident happening and that escalating to conflict is much higher. There's loads of activity both from China's side as it's preparing and from the U.S. and allies.
But is that risk dissipating, given that the Biden administration made such a big push to bring a lot of that chip production back onto U.S. soil? Is the risk of that limited?
Not at all, because they're so far behind in terms of bringing that production online. And also, it's important to realize that it's not just the existence of the high-end chip manufacturing in Taiwan that's of critical strategic importance to the U.S. From a military point of view, if China were to take hold of Taiwan, then the U.S. really does lose sort of the freedom of navigation in the Indo-Pacific. It becomes much more difficult militarily for them to maintain the position they have now, and they're not prepared to countenance that idea.
Can I just come back to economics for a second? We've also got this idea that the Chinese are preparing to weaken the currency. The currency has been weakening. And you could argue that this will be part of a broader export boost that the Chinese hope will deliver some sort of rescue for its economy. Should I be thinking about it along those sort of terms? Do you think the currency could weaken from here? Would it boost Chinese exports? Europe in particular is very nervous about this potential that we do see dumping, that we do see higher exports coming out of China. How big a risk is it?
Look, China is in a serious debt deflationary spiral. Ideally, it should have a combination of default, demand deflation, and devaluation to sort out this problem. But actually, it finds itself in a very difficult situation globally because the West will interpret a significant yuan devaluation negatively and close the doors with tariffs or other retaliatory measures.
So if we see a move in the currency markets, does that accelerate further tariffs, this tariff review that is underway?
Absolutely. Or even without the currency move, but sort of the idea of excess capacity, lowering prices and dumping, let's say take the example of electric vehicles, is something that's already engineering a pushback. But it's important to realize that from China's perspective, actually its strategic long-term goals are not aligned with a significant currency devaluation. And the Chinese will resist a significant currency devaluation because of that. They have spent 30 years trying to convince the global south that the yuan is a stable alternative to the dollar. They have resisted devaluing in the Asian financial crisis, in the global financial crisis. They are loath to sort of abandon those hard-won gains from a geopolitical point of view. But also, when you're such a huge economy, and really, how much bang for your buck does a devaluation deliver in terms of a demand relief?
Yep.
Let's bring it back to the tech conversation as well, because you had mentioned that this was another kind of risk. TikTok had come up in the call as well, so did potentially Huawei. Is there a risk of reciprocity here? If that the United States is targeting Chinese firms, is there the risk of Chinese firms targeting U.S. tech?
There is definitely a risk of the Chinese targeting the profits that U.S. tech companies make in China and tightening the screws themselves. But I think a much more underestimated risk is the fact that this tightening the vice has actually producing a much stronger impetus for China to indigenize. Is that such a word?
Go for it.
There is now.
And innovate even more. And they're throwing a huge amount of money at it. And given how unpredictable the development of technology is, it's not, I think, safe to say, oh, they'll always be far behind. They could actually catch up.
What are we expecting from Janet Yellen? Is it going to be different? Is it just going to be more of the same? Or do you think she'll take a tougher line come Friday?
I think it's more of the same from the perspective that, as we talked, there is no way the Biden administration can be soft on China. And Yellen is there to continue this improvement in communications, but really the two sides are talking past each other. And I don't expect there to be a significant improvement, a worsening, potentially.
All right, Diana Choi-Leva, Chief Economist over at Enodo Economics, walking us through some of the U.S.-China relations there and what it means for the global economic story. Guy, I thought it was interesting because she mentioned some of the geopolitics there as well. And I think it's important for a global audience to remember that the Taiwan story, the South China Sea story, it's important from an export perspective as well. But it's also the least funded part of the U.S. Navy in the entire kind of fleet that they have. There have been issues that lately, we haven't really covered it in this region particularly, but China and the Philippines really getting into it. The United States backing the Philippines in a lot of ways because they don't have the funding for their own fleet in that region.
It's been something that's been on the radar for such a long time as well. Spratly Islands, what's been happening in this region, freedom of navigation. This has been an area that has been a huge focus for China. China has built up its blue water fleet year after year after year, and it is now incredibly powerful in terms of its ability to project power. So that is something that has continued to confound the U.S. military. Are we going to continue to see, therefore, the rivalry? And I think the answer probably is yes. I thought what Diana said about the fact that the Chinese won't want to let the currency go was fascinating. They want it to be perceived as an alternative to the dollar. And if they let it go, that is going to evaporate very quickly.
Is it? I mean, can we just talk about the real ramifications of that? This feels like a de-dollarization conversation that kind of comes up every couple of months.
I don't think it is. I think it's a we want to be a source of stability. This is about spheres of influence, and it goes back to the Cold War in so many ways in terms of spheres of influence. Having a stable currency is maybe part of that in the current world. The economic kind of projection of power that generates, I think, is hugely significant. And I think the Chinese will be mindful of that.
Do you think that'll get kind of emphasized or doubled down upon if we get a Trump 2.0, or if we start to see the U.S. finances get off the rails in January 2025? Does China then say, "Hey, look, we've got it together"?
Well, that's maybe what they're waiting for. They're waiting for that event maybe to take place. I think if you get 60% tariffs on Chinese goods, I think all of what we just had, the discussion we just had, is going to be very different very quickly.
I'm still so intrigued to find the economic case for tariffs, right? Because the whole idea of it is that you kind of bring back the geopolitical protection, you source things here, you have control over pricing, you have control over all of that, and yet every single analysis says that's actually not the way it works.
I think it's about jobs, and I think Yellen's learned that. There's a great piece in the journal this morning talking about her lesson that she learns about the impact that it has on U.S. jobs and the hollowing out of U.S. manufacturing. I think that's one story, but I think it's just slowing China down.
Yeah.
And that military progression that has been made, and as we go into AI, that's why the focus on chips exists there as well.
But when does it start to show up in the U.S. data is my question, because when you did see that Chinese slowdown, the growth slowdown as well, you saw it show up in things like LA imports, for example, these kind of wonky pieces of data. You saw it show up in factory orders and factory prices and things like that. I'm curious what the early signs are that things are either ramping up or slowing down, and where we see it before it's more vocalized by whoever the next leader of the United States is in 2025. Anyways, all of that we're going to be digesting, in addition, of course, the ramifications of inflation, but specifically, at least in the next hour, what's going on right here in Europe. Coming up, it's a big week for Euro area data. CPI numbers coming out at about 10 a.m. UK time. It's an hour and change. Stick with us. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
48 minutes is the equity market session this Wednesday, the 3rd of April. The scorecard looks a little bit like this. Most of Europe ticking a little bit higher, but only just. The FTSE 100 is underperforming right now, which is worth paying attention to. You are seeing a little bit of a reversal of some of the outperformance you've seen over recent days. Stocks like Astra maybe acting as a little bit of a drag. In terms of the bond markets, yields are back to ticking higher, which is worth paying attention to. The US 10-year is up by 3 basis points this morning as that sort of story continues to develop of the potential for the Fed maybe not to be going quite as aggressively. We're going to get more details on that in terms of kind of filling in the blanks when we get inflation data pretty out of the Eurozone very shortly. The expectation there is that actually we're very much still on track with this disinflationary trend.
I'm curious what's driving that, though, because we're still watching wage data, obviously, for the ECB. The manufacturing numbers coming out yesterday showed strength over strength. Spain, Italy, France, not so much Germany. Not even in every region of Germany, you saw a little bit of a slowdown. I'm curious what's actually going to be driving that story.
So the wage story is certainly maybe one of the reasons why the core is being slightly more hawkish in terms of the central bank language that we are getting. German inflation easing for a third month in March, kind of supporting expectations that the European Central Bank will start lowering rates in June. There's been kind of chat over the last couple of days that maybe April is a live meeting, that maybe actually April, the meeting we're going to get next week, could be a little bit more dovish than maybe anticipated. Holtzman, certainly out this morning, Robert Holtzman, pouring cold water on that idea. But are we in a position with the data developing as it is at the moment for a more dovish tone to start to develop as early as next week? Let's get the take now of Jana Randau ahead of the inflation data that we're going to be seeing a little bit later. Jana, first of all, let's start with that inflation data. Is this going to change or just simply just confirm the narrative that the ECB has been pushing?
No, I mean, what we are going to see is an inflation rate that is approaching the 2% target pretty much as planned. The median expectation we have from economists is for a 2.5% reading for March, and you could argue that's within an arm's length of the ECB's 2% target. Now, is that enough? No, it's not enough, and policymakers see various risks that the last mile might be hard to achieve, one of which, or one of the reasons you mentioned, is wage growth, and that is truly a concern. And just overall, the inflation readings over the next couple of months are going to be bumpy, so we're going to see a lot of up and down. Also diverging trends across the region. We've seen some of it already from national data out over the past days. We saw slowdowns in Germany, you mentioned it. We saw a slowdown in France as well. We saw pickups in Italy, in Spain. That has to do with how energy aid is phased out, how base effects play out, how the timing of flexible holidays impacts inflation readings always around the springtime of the year. So it'll be quite difficult for policymakers to read what's going on, beyond the obvious trend that inflation is coming down. So, talking about April, yes, they will take stock. They will have a lot of data to digest, but everything I've heard over the past days, over the past weeks, makes me convinced that that a rate cut at the April meeting, at next week's meeting, is very, very unlikely.
Well, talk to us about what is priced then. When do we see that first move?
Yeah, so it seems all the stars are aligning for June, and the strongest piece of evidence obviously came from President Lagarde herself during a speech at the ECB Watchers Conference at the end of March. where she said, we will have somewhat more data in April, a lot more data in June, and that will make us a lot more confident to decide on whether that rate cut needs to happen. And of course, what she means is that June will see an update to the ECB staff projections, a big one as well that incorporates views from all across the Eurozone. They will have wage data for the first quarter available, obviously with wages such a big impact for domestic inflation, for services inflation, which is running a lot higher than the headline numbers, which is a cause for concern, because obviously as inflation comes down, as wages pick up, consumers will see real wage increases this year, and the hope is that they will boost private consumption to an extent that the economy can return to healthy growth. But also, of course, there is a concern that too much demand will fuel inflation, will keep price pressures higher for longer than policymakers want. So it's a fine line they're treading, and I believe that next week is just not the time where they will be comfortable with the information that they have done enough, that policy has done its job.
Yeah, and I've asked you this question 100 times. I'm going to ask you it again because we're getting closer to the moment. If the ECB is looking to cut aggressively and the Fed isn't, how does that change the calculus? Will that change the calculus? I know that they say that they are not Fed dependent, but it's a pretty big kind of influence over global rates, particularly at the longer end.
Of course, and it's interesting that you mention it, because we've had a lot of discussions about just that topic here over the past days. And I mean, there are different ways of looking at it. You could say if the Fed isn't cutting rates as aggressively, that has to do with the fact that the U.S. economy is stronger, that inflation trends there are stronger, that domestic demand there is stronger, which of course then will also spill over into the Eurozone after a while, giving both inflation and hopefully growth a boost, which means monetary policy might not have to ease as much. The other argument would be that if the Eurozone really slides into something the ECB doesn't want to see, then of course it will have to deal with it, and will have to do. I think the ECB has proved over the past years that it can act alone, that it can walk alone. Policymakers are committed, and they will certainly try. But we all know that the U.S., and the Fed in particular, sets financial conditions for the whole world to some extent. Yep. So can they act in a vacuum? Absolutely not.
Jana, great to catch up as ever. Thank you very much indeed for setting us up in advance of that data. Jana Rando joining us out of Frankfurt. While that's been happening, we've also had comments coming through from the Italian finance minister saying that he thinks that Brussels will open a deficit procedure against his country. In some ways, we've all been surprised that we haven't seen this kind of accident in Italy as rates have gone higher. One of the reasons the Meloni government has been spending hard, its deficit has been widening. The EU's starting to pay attention. Markets might as well.
It has, but not widening, yes, but it's still relative to the kind of 2020 numbers. It's still, the budget's looking better than what it was. And I think that's the argument you're going to hear from a lot of Meloni officials as well. I think Il Sole, one of their newspapers in Italy, reporting this morning, their forecast is 4.3% of their deficit by the end of this year. How likely is that? Maybe not so likely based on this.
But it's kept Italy out of trouble. And it's really interesting that kind of that has been such a big story, and also that spending is expected to start to roll off.
Yeah.
So maybe the fiscal impulse starts to fade out of the economy. Does the data turn at that point to become more negative? Do you see those spreads widening out a little bit? Is that something that we should be paying attention to?
But that's where you see, I think, a comparison between Italy and Spain very, very closely, because the numbers look similar. Spain has not seen that same fiscal impulse that Italy has.
You're going to be doing the pulse?
I am going to be doing the pulse. Here. I know, for another hour. And I'm thrilled to be here.
Whole extra hour of Krithi Gupta coming up next. The pulse is up next. We're going to be dealing with that inflation data. We're going to be counting you down to that story. That is coming up. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London with the conversations that matter. Here's what's coming up on today's program. Taiwan hit by the worst earthquake in 25 years, killing at least 4 people and disrupting some chip production lines. Meanwhile, Xi and Biden talk, but say very little on the imminent U.S. tariff review. The focus now turning to Janet Yellen's trip to China on Friday with a tougher line from the Treasury Secretary now anticipated. And European stocks mixed on speculation that rates are going to stay higher for longer. Euro area inflation data due today about 10 a.m. Another step closer potentially to the ECB's 2% target. Now let's take a quick look at the European markets map. Look, we are seeing a little bit of a mixed picture. Risk sentiment souring just a little bit. You are seeing, some underperformance on the FTSE 100, down 0.6%. Look, it's been a marathon day already this morning. When we're talking about some of the headlines here, the underperformance of the UK might simply be a little bit of a pullback that you are seeing specifically from that record high we saw on the FTSE 100. But again, some micro stories that we're going to be watching there as well. Limited movement in the rest of the continent, though. When you look at the DAX, when you look at the CAC as well, those kind of indexes on the continent, not seeing that much. How much of that is waiting for the inflationary data that we're going to get? In the meantime, I want to get a quick check on futures as well and where we are actually over in the U.S. session, because remember that time change has kicked in now. So we are seeing some of the risk sentiment from Europe, from Asia, kind of slide in here. Now remember, the ramifications out of the TSMC story, out of the earthquake in Taiwan, still yet to be digested by the U.S. markets. Plus, you've got Intel down pre-market. We're going to dive into some of the tech stories in the United States that may be driving the underperformance you are seeing in the NASDAQ 100. In the meantime, let's go cross-asset here because, like I said, the euro area inflation is due out shortly at about 10 a.m. UK time. How much of that moves the market in the 10-year yield? You are seeing 438 on that benchmark for the 10-year. This is important because, look, it's coming off those comments that we got from the Fed's Messenger and the Fed's Daily, basically saying 3 rate cuts are still priced in this market, or at least expected to be by the end of the year. Is the Federal Reserve, however, running out of time? That's going to be a story that we watch. In addition to some of the geopolitics around the world, remember, you are seeing Brent crude get closer and closer to that $90 a barrel level. 88.98 is where we are on that commodity. In the meantime, let's get to one of our top stories here. Taiwan's fire agency reported as saying 4 people have been killed in the strongest quake to hit the island in a quarter of a century. Joining us now, Robert Lee from Bloomberg Intelligence. Robert, a pleasure to have you on the program. Bring us up to date with the developments on the ground.
Yeah, no, thanks very much. As you said in your intro, this is one of the largest earthquakes that's hit Taiwan in recent history. Having said that, just to give you a very brief geography lesson on the island of Taiwan, Taiwan is a very densely populated island, although the majority of the population lives on the periphery and mainly on the west coast. This earthquake hit on the east coast in a place called Hualien, which is a very beautiful but less populated and more rural area of the island. So in geographical terms, Hualien, or where the epicenter of the earthquake was just under 200 kilometers from Taipei, which is the capital of Taiwan. And therefore, the major damage seems to have been concentrated on the eastern side of the island, not in the capital. And also the major industrial and science parks within the island, I should say, where the likes of TSMC and its peers are located. Again, they're on that more densely populated west coast. There are well-developed protocols and procedures in place that are put in place to protect human life, first and foremost, but also to protect the buildings and assets. So they seem to have worked like clockwork. The buildings were evacuated, production was shut down. So I think the conclusion to all of that is, whilst there may be some production lasting a number of days, at this point it looks like the impact on the Taiwan food chain and wider global food chain is likely to be fairly limited based on where we are today on what we know so far.
You're talking about not having as much of a global ramification as some of the damage is still being expected, or at least assessed. Is there a more shorter-term ramification, though, when you look at TSMC in particular?
Again, based on limited information at the moment, I mean, these fabs of TSMC are built to be as earthquake-proof as possible. So the buildings and the design of them themselves in sort of rubber buffers and other things to protect the equipment and protect the individuals that work within them. So I think if we were talking about a scenario where the epicenter was very close to one of these facilities, clearly the potential damage could be larger. But based on what we know so far, production was shut down, the procedures worked as they were supposed to, and whilst TSMC hasn't given a formal update, I think looking at the facts and taking a logical conclusion, the impact on their production is likely to be relatively minimal. And again, don't forget that Taiwan is an island that sits within the Ring of Fire, and whilst today's earthquake was larger than what they would normally expect, you know, earthquakes are of a frequent occurrence in Taiwan. So this is nothing substantially new, but obviously of larger magnitude than what we've seen in recent years.
It's interesting because it's coming, of course, at a time that we're talking as well about potentially U.S. production and U.S. kind of domesticity around the supply chain as well. We still have a little bit of the market reaction pointing to that risk sentiment. Robert, there's a lot going on in the chip space. The read-through from the TSMC story, which, by the way, closing down in the market by about 1.3%, I believe, in the Asian session. Is there a more market read-through? Why are markets in particular spooked if, as you point out, the implications might not be as severe?
Yeah, I mean, TSMC has traded off, but as you said, I mean, we're in the low single-digit range, and I think if we were seeing larger share price declines, you know, 5–10% would probably be indicative of wider concern on both their business. So we're not seeing that. I'd also say, just looking at technicals for a moment, you know, TSMC's share price has been hitting a key technical level recently, which has been struggling to break through. So you need to sort of see it in that context as well. But again, on fundamentals, I would say, based on everything we know at the moment, then there is unlikely to be a long-lasting impact on TSMC's production, neither impacting their business and probably the read across to the wider tech food chain, the likes of NVIDIA, etc., again, are likely to be more minimal based on the information we see at the moment.
All right, Robert Lee from Bloomberg Intelligence breaking down the impacts of that Taiwan earthquake and what it means for the global supply chain. We thank you so much. In the meantime, we are getting a redhead crossing the Bloomberg terminal. China relaxing the loan ratio for vehicle purchases. Remember, this comes in the context as well as when we've seen a lot of the EV deliveries and that kind of a leader of electrification, perhaps dissipating just a little bit. For now, we are getting that headline about the loan ratio. We will get more headlines to you as we get more information. In the meantime, I want to go to the geopolitics here. President Biden and his Chinese counterpart Xi Jinping have spoken by phone in their first one-on-one communication since November. For more, I want to bring in Bloomberg senior reporter on China's economy and government, James Mager. James, a pleasure to have you on the program. It felt like the readouts didn't yield a lot, but I'm curious what stood out to you.
I think the thing that stood out most was they seemed more cordial than the previous statements we've seen from these kind of discussions. I mean, obviously these readouts are from both sides very much emphasizing what they wanted to talk about and what they thought was the most important thing. But especially the Chinese readout, there was less of the complaining and the sort of pointed complaints that you've seen about American actions than I think there's been previously. And there was a lot more emphasis on how the two sides could cooperate and how this was important, that they had been building stability and they should continue to build stability. And so I think from what we can tell from the readouts that we see, it did seem like the conversation was more cordial than things have been, say this time last year, when relations were incredibly tense. Obviously, there are still many issues within the relationship, and you saw that in the Chinese statement where they were very vociferous in complaining about U.S. technology sanctions and how they see that as trying to stop the development of China. But obviously the U.S. readout mentions fentanyl, which is a big issue where the U.S. wants China to do a lot more to try and stop the flow of precursor chemicals to Mexico and other places, which they blame for the fentanyl crisis in the U.S. But, I mean, overall, I think that, as I said, the thing that jumped out was the fact that it seemed less aggressive or less carping and complaining than we've seen in the past.
How much of a precedent does this set, then, for Janet Yellen, her visit to China this week? There's a lot of concern about devaluation in the yuan. What does that mean for not only the export story, but also for Treasury inflows? Walk us through the significance, or lack thereof, of Janet Yellen's visit.
I think the Treasury Secretary's got a lot of things she wants to speak about while she was here. And there's dozens of points over here on the list of things that have to be discussed. One of those is obviously, as you said, the yuan is weakening, and there is a lot of pressure on it to weaken further, and it's sort of bumping up against the bottom end of the band that the central bank has set. And especially if the Fed keeps rates higher for longer, that's going to only increase the pressure on the yuan to weaken, because the PBOC is going the other way, and they're trying to cut interest rates or trying to increase monetary easing to support the economy. So that's going to increase pressure on the currency, which is not what other countries want to see. They don't want to see China, in a sense, devaluing the currency or allowing the currency to devalue, because that would boost exports. And that leads into one of the other big problems that Janet Yellen wants to talk about while she's here, which is what the U.S. sees as the issue of Chinese overcapacity. There's a lot of different ways you can look at what is Chinese overcapacity or Chinese industrial capacity. And I think some of the complaints from the U.S. and the EU are overstated. There's lots of overcapacity in the market here, but a lot of that is on stuff that isn't traded, isn't exported, like cement, rebar, because of the housing market crisis. And that's not really a decision by China to have a housing market crisis to that extent. So there's a lot of things that they want to talk about, but I think it's a good sign that the discussions we saw overnight is a good sign leading into the meeting, the Janet Yellen's visit later this week.
All right, Bloomberg's James Mager joining us from Beijing to talk to us a little bit about that U.S.-China relationship. We thank you so much for bringing that to our attention. In the meantime, I want to bring up one of the major stocks that we are watching in the pre-market. This, of course, having implications for the technology story around the world. Intel down about 4% in the pre-market after saying that losses have deepened at the chip maker's factory network, and the business may not even reach a break-even point for several years. Remember, this is coming amid a very big kind of cost-cutting mission from Pat Gelsinger, a turnaround story for Intel, which doesn't seem to be going their way. Those worries and that pressure and that announcement pressuring the shares down about 4% this morning. Coming up on the program, we go from the stock market to the bond market. Hopes of quick rate cuts from the Federal Reserve fading after some strong data on the U.S. economy, plus some Fed speak. Mary Daly saying she still believes there will be 3 reductions this year alongside Loretta Mester. More on that next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence. Some further monthly readings will give us a better sense of whether the disinflation process is stalling out or whether the start of the year readings reflect a temporary detour on the downward path back to price stability.
The labor market is still going strong and growth is going strong. So there's really no urgency to adjust the rate. We need to be sufficiently confident that we're on the right path of rebalancing the economy and bringing inflation down to 2%.
Commentary there from Fed officials Loretta Mester and Mary Daly giving their view on rate cuts. The consensus, at least between those two, seems to be 3 rate cuts by the end of the year. But what is the read-through globally? Is there even one? Let's bring in a true expert. Elise Benoit, Managing Director and Head of EMEA Research over at Citigroup Global Markets, joins me this morning. Talk to us a little bit about what we're watching from a macro perspective at a time when the discussion seems to be around a potential divergence between the Fed and the ECB. Connect the dots for us here.
Right, so we're just coming out of a lot of bottom-up data during the results season, full-year results season globally, and obviously now refocusing completely on the macro data. Clearly, inflation has been sticky around the world. We've seen inflation coming down for goods, for consumer goods, for core inflation, but unfortunately, services is still quite, we're still seeing sticky inflation there. That's basically what markets, I think, have been really focused on. Certainly, that's the investor feedback we have. But going forward, the key question is obviously around cuts. We at Citi are still forecasting a series of cuts starting from June in all major developed markets, so Bank of England, ECB, and the Fed.
When we talk about the ECB and these rate cuts that a lot of people are saying seems to be potentially front-running the Federal Reserve when you talk about weakness here in Europe, is that a tailwind for European equities, or does the growth picture overshadow the equity story here?
I think, with equities, obviously, we're forecasting very mild gains. In Europe, probably high single-digit gains to the year end. But we've recently upgraded our EPS forecast from 3% to 6% for this year. Yeah. And that's really trickling through some mild GDP growth, some mild GDP improvements that our economists are seeing. Where we have perhaps some lightness in the economy, obviously PMIs have not necessarily, they're bottoming, but they haven't precisely ticked up. So I think that's what we're watching in terms of going forward.
Talk to us about the EPS story, though. It's interesting that you peg that to growth as opposed to growth or consumer resilience in the United States, where it feels like that has been feeding a lot of the outperformance for certain companies in terms of revenue here. How much of the exposure to the United States is, one, a tailwind, or two, a risk if we see a slowdown there?
I think, what's key, I'm going to talk here about European equities specifically, is obviously, Europe is exposed to, is a very international style market. So let's not make the mistake of assuming it's a proxy for European economies, and right. Especially for the UK. I mean, this is really true. The UK is a hugely international market. So obviously, growth has to come from internationally. And I think you haven't mentioned China, but China is huge in this picture. So actually, less than the US, I would look at China for a source of growth. And any positive news from China, any sort of, I wouldn't say necessarily positive, but certainly easing news from China is very important for European equities. And I think that's a key driver.
It's interesting that you talk about China, and yet you're still doubling your EPS, at least for the year. Given that China's still in an economic slowdown, one I would argue that's more severe than any other country, or at least in the ones that we watch in terms of Western economies in the entire world. So why the divergence there? If EPS is expected to double, in your view, does the Chinese consumer play more into it, or is it more of an export story?
Yeah, I wouldn't say it's exactly doubling. I mean, we're going from 3% forecast up earlier this year. The market was pricing probably 5% down. It's corrected. Yeah. We got to that point. We've had a lot of interesting information at full year results, and we're moving up to 6%. It's still, mid-single digit. It's still very subdued. In our targets, when we expect the market up mid-single digit, we do not expect, a re-rating. It's purely, the same multiple applied, which is, 12, 13 times really applied to the same EPS growth. So I think where the growth is coming from, first of all, resilience in margin. I think we've seen incredible resilience in margin. We're very surprised. I guess the market was certainly surprised by that. And sources of growth quite well diversified, frankly, in Europe, and some fairly unique sectors, like luxury goods, are doing very well.
Yeah. So we've got the China story. We talked a little bit about the United States. I want to zero into the commodity story and the FX story. What drives, or what affects, I think is a better way to put it, the European equity story at the moment? When we're looking at oil, just shy of $90 a barrel, when we're looking at almost continued weakness in the euro dollar, positioning that suggests more euro weakness to come. Put that together for us, the FX and the commodity read-through into the equity market.
Sure. So commodities is very important. I mean, obviously, all eyes are on the oil price. I heard earlier on the show this morning talks about the oil price at 100. Obviously, what's key for the equity market, the read-through, is whether the oil price coming up is an external shock or whether it's a consequence of an economy faring somewhat better. So whether it's demand-led or whether it's, for example, a deterioration, which we haven't seen, of geopolitical conditions. Clearly, the mechanism of transmission to the economy of a higher, of an external geopolitical shock, for example, the crisis in the Middle East, is the oil price. When the market sees that, when they see that mechanism of transmission through the oil price, it's a negative sign, and it leads to longer inflation and problems. When we have an oil price that's, so to speak, healthy because the economy is faring better, it's always a good sign for the European economy, particularly the UK economy, which is almost a proxy for oil.
Yeah. So much more to digest there. Sadly, we're out of time. We thank you so much for joining the program. Elise Badwa there from Citigroup Global Markets joining us this morning. Coming up on the program, we'll dive into a little bit more about what Elise was just saying there. Inflation in the euro area expected to drop further. We're going to discuss what this means for the ECB as the pressure grows to cut rates. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Euro area inflation for March due in about 30 minutes time. I want to get more of Bloomberg's Jana Randau. Jana, walk us through what we're expecting. How does this change the game for the ECB?
So what we are expecting is another slowdown to 2.5% for the Eurozone as a whole. So definitely a move in the right direction that will obviously, be a welcome piece of information for policymakers from across the region. Will it be enough for the ECB to maybe decide already next week to cut interest rates? Probably not. The policymakers have said that they need more information. They want more, more data on the economy, on wages. So we'll have to sit tight.
Jana Randau, thank you so much. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Taiwan hit by its worst earthquake in 25 years, killing at least 4 people, intercepting some chip production lines. Xi and Biden talk, but say little on the imminent U.S. tariff review. The focus now turning to Janet Yellen's trip to China on Friday, with a tougher line from the Treasury Secretary now anticipated. And European stocks mixed on speculation that rates will be higher for longer. But Euro area inflation data due today could be taking another step closer to the ECB's 2% target. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Look, there's a lot to digest from the geopolitics to the economic data, but first we want to start with the currency story. The yuan, the Chinese yuan, weakening to its weakest levels that it's allowed to trade at against the dollar. Remember, there's that 2% daily trading range, and you are seeing a little bit of a reaction in the yuan as well, against the dollar, against the yuan, the offshore renminbi, I should say, 726 at the moment. You are seeing a little bit of a bump on that as we talk about that approach closer to it. It's coming off concerns around export data, concerns about the Chinese economy. What does some sort of move to stabilize the currency do for currencies around the world and the Treasury inflow story? That's just one part of the geopolitics. Let's get to another and go to the commodity story. Oil up more than 1.5% over the past 3 days. It comes as an industry report points to a drawdown in U.S. crude inventories. It also comes ahead of an OPEC Plus meeting expected to affirm current supply cuts. Joining us now, Bloomberg's Anthony DiPaolo. Anthony, a pleasure to have you on the program. A lot of volatility with oil. Just an hour ago, we were talking about whether $90 a barrel, potentially $100, were on the docket. Now we're seeing oil in negative territory. Walk us through what's moving it.
Yeah, I mean, slightly down a little bit right now, but in general, keeping some of those gains from the first quarter. So oil did a pretty good, had a pretty good performance in the first quarter in terms of rising, and we've kept those levels. So we're closer to 90 really these days than we have been for the whole year. And that's on the back of a lot of the geopolitical pressures that built throughout the first part of this year in terms of the Israel war in Gaza and a lot of the attacks on tankers there. Those perhaps haven't moved oil as much as people would have thought initially because we haven't seen oil tankers and oil supplies actually affected. But there is a longer route that's affecting freight rates, that's affecting insurance, and so that is having an impact on the market. There is a little bit of risk in there. And now we're seeing, as you said, those higher inventories, those inventory draws, rather, from the United States, which is a very important market where traders watch those commercial stocks to see what's happening. And OPEC Plus is continuing its cuts, trying to draw some of that oil out of storage and stop a buildup of stockpiles in the market, Kriti.
We're talking about this kind of tailwind for the oil story. Inventory drawdowns, yes, but it feels like the overarching theme has been supply from the United States, supply from some of these other producers, as you laid out. Could $100 a barrel come in the next couple of months? What's the outlook?
You know, this is what OPEC Plus has really got to balance, and that's why we're seeing those cuts, is that they are trying to compensate for those other barrels coming online in the United States, in Brazil and Guyana. A lot of those barrels coming on are expected to make up for a lot of the demand that we're seeing added to the market. So it's a roughly balanced
picture depending on how you see it. Now, the question is, will we see those demand signals come in more strongly? Will that Chinese recovery finally kick in fully? We're seeing signs that it's picking up a little bit, but it was slower than OPEC Plus hoped coming out of COVID. So we'll see how that plays into the rest of the year. But OPEC Plus is staying the course for now. Those cuts are in place at least through the end of the first half, potentially longer. And so we'll see how that develops, how they see the market and that other supply coming in, whether they need to keep those barrels off the market. Of course, when they do start bringing those barrels on, more likely towards the end of the year, that is going to have that downward impact on prices. But we are hearing discussion about, as the market tightens towards the end of the year, seeing those higher prices, 90s, 100s. We're talking about those levels again, Kriti.
All right, Bloomberg's Anthony DePaolo walking us through that bull case for the oil story. We thank you so much for walking us through it. In the meantime, given all those kind of supply-demand dynamics, you also have the geopolitics to factor in as well. President Joe Biden now saying that Israel has not done enough to protect civilians after the death of 7 aid workers, marking some of his strongest criticism yet in terms of the Middle East. This comes as Iran vows revenge on Israel after blaming it for a deadly airstrike on its embassy in Syria. Joining me now, Fawaz Gerges, chair and professor of the contemporary Middle East at the London School of Economics. Fawaz, a pleasure to have you on the program. This criticism that we're getting from President Biden, being very outspoken, following some of the criticism he's getting and pressure he's facing domestically, from your perspective, does it change how things may play out on the ground?
I fear not. I think there is a big disconnect between words and rhetoric coming from the White House and actions. You mentioned that the president said that Israel has not done enough to protect civilians. We're talking about almost 33,000 Palestinians who have been killed, 74,000 who have been injured. Aid workers, almost 200 aid workers have been killed in the past 6 months. Nurses, doctors, storehouses. I think without leverage, the President of the United States so far, despite the spat of word with the Israeli Prime Minister, he has not used any leverage to really pressure Israel, not only to minimize civilian death, but also to accept a ceasefire, a permanent ceasefire. As you know, the Security Council basically passed a resolution calling on Israel and Hamas to have an immediate ceasefire. Yet what we are seeing in the past few days, sadly, is that Israel has been escalating in Gaza, in Syria, on the northern border in Iran, and the West Bank, the occupied West Bank. So the situation without leverage, without the Biden administration taking actions. Final word, I'm sorry I have spoken too long. Even though the president says that Israel has not done enough to protect civilian lives, the Biden administration now is in the process of sending one of the largest military packages to Israel, 18 billion US dollars in arms to Israel in the next few days when it passes the Congress.
A weapons review that was in place for years, or I think in scheduling, I should say, for months to come. Fawaz, talk to us about the leverage from the regional players, from the Middle East in particular, the UAE, Qatar, Saudi Arabia, among others. What does the regional focus look like? Why is there not more pressure there?
Well, look, really, I just want to tell you viewers, I'm not talking politics here. The United States, the Biden administration has humiliated its regional partners, Egypt, the United Arab Emirates, Saudi Arabia, Qatar. They have been begging the administration to accept a ceasefire, a humanitarian ceasefire. Think about it. How many times the Arab foreign ministers, the Arab president, Al-Sisi of Egypt, Mohammed bin Salman in Saudi Arabia, Mohammed bin Zayed in the United Arab Emirates, that the United States, the Biden administration, has consistently opposed an immediate ceasefire in Gaza. And when it abstained in the Security Council, the Security Council passed unanimously, 14 members voted for a unanimous ceasefire. What did the administration do? What did the Biden administration say? After the passing U.S. Security Council, he said that it's not, basically, Israel does not really have to abide by the resolution. He said it's not really, obligatory on the part of Israel, and it will have no impact on Israel's policy. If I were Benjamin Netanyahu, I'm talking from realism, the school of realism in international relations. If I were Benjamin Netanyahu, the Prime Minister of Israel, why would I stop the war? If I have American arms, American political support, no pressure on me. Benjamin Netanyahu cares for one audience, one single audience, that is President Biden and the Biden administration, because the entire world community, including the United Kingdom, where you and I are, basically voted for an immediate ceasefire.
Let's talk about the foreign policy argument in favor of the way the Biden administration is acting. And the reason I bring this up is just to kind of understand the counterpoints here. One of the arguments to continue that support with Israel, the historic support, has been to offset the pressures from Iran in particular, even just in terms of the latest headlines with Israel's attack on the Iranian embassy in Syria. There is a lot of question of what that counterattack, that reciprocity might look like from Iran. Fawaz, walk us through it here. After years of sanctions, years of economic turmoil, a Red Sea situation that's not getting better anytime soon, what is Iran's response?
Well, I think the simple answer is that we don't know, right? We are speculating, you and I and all of us. But I think if you ask me about Iranian strategy is that does not really want a direct war with either the United States or with Israel. Iran has repeatedly said so. The Americans have made it very clear that Iran does not really want war. What we are seeing now is that really, again, no politics. Israel is pushing Iran to the limits. Israel is trying to show that Iran is a paper tiger. It's trying to degrade Iranians' deterrence. It has repeatedly attacked Iranian targets, not just in Syria, but also inside Iran, as you know. Scientists, diplomats, commanders. It's pushing really Iran. My take on it is that the Iran's National Security Council yesterday has made a decision to retaliate. Make no doubts about it, it will retaliate because the attack in Syria on Friday was really a game changer. It attacked Israel the first time, attacked really Iranian sovereignty and Iranian consulate. It killed 7 senior officers, including 3 top Al-Quds Revolutionary Forces generals. But my take on it, again, I could be wrong. Iran will retaliate, but a limited response. Iran does not really want to provoke all-out war with Israel, even though Israel really is pushing the envelope on the northern front in Iran, because Iran fears that Israel is trying to drag it into all-out conflict with the United States, because if war were or was to break out between Israel and Iran, the Iranians fear that the Americans will come in to protect their most important ally in the region, Israel.
A lot of complexities in the region, a lot of complexities in the foreign policy of multiple Western countries and how they're reacting to what's going on, to the humanitarian toll on the ground. Fawaz Gerges, we have to leave it there, but we thank you so much for your analysis, joining us from the London School of Economics. Coming up on the program, we go from geopolitics to the earnings story, companies to watch in the second quarter. Bloomberg Intelligence gives us their top 10 picks and the reasons behind it. That conversation next. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more I would say volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down, right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Bloomberg Intelligence has identified 10 companies to watch in 2024's second quarter across sectors and regions, all part of a larger group of high-confidence focus ideas that BI analysts flag on an ongoing basis. Let's dive into the details. Bloomberg Intelligence Director of Research and European Strategist Tim Craighead joins us this morning. Before we dive into the specific companies, talk to us about methodology here.
Yep. So these 10 are part of a broader list of what we call focus ideas, as you referred to. These have three pillars that they stand on. One, there's a high conviction fundamental view that the analyst has. Number two, it's different from what the market appears to be discounting in some way or another. Quite often we compare these to consensus estimates. And number three, most importantly, there are catalysts ahead that can bring the market around if we happen to be right. You can find all these on BI Space Focus on the terminal. There you go. These 10 specifically have catalysts coming up in the second quarter, and that's why we've zeroed in for these 10.
Talk to us then about the companies specifically. They're not all European-based.
Yep.
Walk us through the logic there.
So there are three that are European, and they span certainly sectors. One is Accor, one is Standard Chartered, one is Pirelli. That gives you a sense of the diversity.
Yeah.
Accor, travel recovery, big story. We think it's got more legs than what consensus right now thinks. If you go to travel and you're booking a hotel, it's kind of shocking how expensive hotels are. That's feeding right through to Accor's margins. And you got the Summer Olympics coming up, which is one of those catalysts for these guys. Pirelli, tire company, it's shifting its production to lower cost places like Romania and Mexico, and it's upgrading its mix to higher and higher end products. Again, driving better, we think, earnings. Standard Chartered, we think, is provisioned against its China property woes. And the growth in asset management, wealth management for them in Asia is quite dramatic, and we think is underappreciated. So that gives you a flavor for three that happen to be in Europe.
Yeah, interesting dynamics because they're all different fundamental stories, regional diversity there as well. Bloomberg Intelligence Director of Research and European Strategist Tim Craighead joining us this morning. Of course, you can find more of that analysis on BI Focus. Now, plenty of more analysis as well from Bloomberg Economics. Donald Trump's tariff plan likely to send inflation above the Fed's target, adding that pressure to raise interest rates. It gets kind of wonky, but Bloomberg Economics crunched the numbers. We're bringing in the senior global economist there, Maeva Cousins, joining us this morning. Maeva, a pleasure to have you on the program. The numbers here were fascinating in terms of the impact it might have on the American economy, specifically when we think of, or at least have Fed advertised, that tariffs are going to have a short-term impact on the American economy. Your numbers suggesting otherwise. Walk us through it.
So yes, thanks a lot for having me. So we've looked at different tariff proposals that's been floated by candidate Donald Trump on the campaign trail, in particular 60% tariffs on all goods imports from China, and an additional 10% tariffs on all goods imports from all other countries. And of course, this second scenario would be the one with the most severe impact. And what we've done is that we've looked at the long-term implications, but also the dynamics of the adjustment. And what we find in this analysis is that after 2 years of these 60% tariffs on China and 10% tariffs on the rest of the world, assuming that they are implemented from the start of 2025 when the new administration comes into office, what we find is that after 2 years, GDP could be 0.5% lower and prices could be 2.5% higher than they would have been without the tariffs. And for inflation, it means that inflation, instead of returning to 2.1%, as most economists currently expect, inflation could return to about 3.7% by the end of 2025, so well ahead of the Federal Reserve's 2% target.
It's interesting that we talk about this kind of deceleration and contraction, really, in the GDP growth that's modeled, because my understanding is it's not just the 60% tariffs in China as well, it's also 10% on tariff from the rest of the world. You have to have both to actually have that kind of contraction. But in terms of one or the other, given that some of the foreign policies, some of the tariffs around the likes of Mexico, for example, or the EU haven't been outlined from the Trump administration, could that then turn these numbers more positive?
It's not, in our estimates, it doesn't turn into positive. We also assume, by the way, that these 60% tariffs on China gets reciprocated from China, so that there is 60% tariffs from China on the US. So it doesn't turn into positive, but the impact, and especially the impact on prices, is more moderate, mostly because basically you can have a much more smoother adjustment by turning to other importers in other countries, other partners, including to some extent possibly some transshipment, where some of the goods are shipped from China, maybe transformed slightly in another country, and then sent back to the US, which really has eases the impact, smoothes the impact.
That reciprocity, of course, very much in focus of what that looks like in terms of the European, the Chinese, the Mexican, among other countries' response. Bloomberg Senior Global Economist Maeva Cousins, we thank you so much for walking us through that crucial analysis. Coming up on the program, more geopolitics at hand. Bloomberg learns that NATO is proposing a $100 billion fund to aid Ukraine as foreign ministers meet to mark the alliance's 75th anniversary. Details ahead. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
For more our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
NATO Secretary General Jens Stoltenberg proposing to establish a fund of contributions worth $100 billion over 5 years for Ukraine. It comes as foreign ministers from the alliance gather in Brussels to mark the group's 75th anniversary. I want to get a little bit more here from Bloomberg's EMEA News Director Roz Matheson, who of course is watching the geopolitics very, very closely. Roz, walk us through this proposal.
Well, as you say, it would be a $100 billion fund over 5 years. And the idea behind that is to really lock in this military aid for Ukraine for a protracted period to get all the member states to contribute financially to that, to centralize some of these movement of weapons, purchases and movements into Ukraine. It would also include bringing into the NATO tent more directly the kind of logistical responsibility for these weapons deliveries into Ukraine. Right now, that's a US-led effort, obviously in conjunction with Ukraine. But the concern with all of this is that if this war in Ukraine goes on, Russia is showing no signs of backing down there in its fight. Is there a point where it becomes even harder to get military aid to Ukraine, given the political climate in the US, given general sense of fatigue? And obviously this is about, in a way, future-proofing some of that aid to Ukraine, particularly, again, with the US election coming up, the prospect of Donald Trump returning to the White House. He's made very clear he doesn't think the US should be supplying Ukraine with aid at all. He's also made many potshots over the years at NATO, questioning why NATO exists, what it actually achieves, and whether the US should continue to give it money. So there's lots of questions there about what aid to Ukraine might look like down the track, regardless also of whether it's Donald Trump in the White House, because even if Joe Biden is reelected in the US, it doesn't seem to be a strong sense of support politically at the moment across the aisle, politically in the US, to keep that aid going. So this is all about finding ways to try and lock in some of that aid, to future-proof it a little bit, at least for Ukraine, because the sense is obviously Ukraine is running very, very short on weapons, even in the immediate term.
Bloomberg's EMEA News Director Roz Matheson walking us through that crucial NATO story. And look, it's not just the only thing we're watching, because there is the inflationary pressure, there's the fiscal pressure as well. Not to mention the OPEC story, plenty of Fed speak, but what's got our eye in the next 5 minutes is Euro area inflation data, those CPI numbers coming in just a few minutes, 10 a.m. UK time. You don't want to miss it. We'll have full coverage right here on Bloomberg TV.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from our world headquarters in New York. I'm Manus Cranny. Danny Berger is out for the rest of the week. Let's set your agenda on Bloomberg Brief. Mester and Daly say a trio of rate cuts this year are still on the cards, although they are in no rush. Presidents Biden and Xi speak for the first time since November. AI risks, Russia and fentanyl are on the agenda. Taiwan is hit by the worst earthquake in 25 years, killing at least 7 people, disrupting the chip production. We are live to Taipei. Breaking news for you hitting the Bloomberg terminal now on Europe, European CPI. This is what we have for you. The year-on-year number comes in less than estimated at 2.4%. The core reading also coming in tighter than the market had estimated. This is the month-on-month reading at 0.8%. The market had penciled in 0.9%. Very first reaction in the euro there, just fairly flat at the moment. So these look on the headline to certainly be beating on the CPI, on the headline by 0.1%, on the headline CPI, and on the core coming in at 2.9%. Of course, services inflation has been stuck at around 4% for the past number of months. We know that food has been one of the biggest in the equity market, finally to the higher for longer narrative. The Nasdaq dropped by 1% yesterday. Adding to that on the downside, Tesla was one of the big laggards. The Russell, of course, down by nearly 2% yesterday. MSCI Asia down 0.7% on the back of this earthquake in Taiwan, the 7.4 magnitude earthquake. A couple of individual stocks to keep an eye on as a result of that earthquake in Taiwan. You are looking at a number of ramifications. Taiwan Semiconductors down by 1.25% at the moment. There was a tsunami warning around the rest of the region. One stock to keep an eye on as well from the American perspective is Intel. Their foundry business, the chip-making business, delivered losses of $7 billion. We were updated last night. That's up from $5.2 billion and will not break even until the year 2030. Roll it over, have a look at the bond market. I would say that the bond bears are in charge, not the vigilantes. You are seeing a third day of a rise in yields. You've hit the highest since 2024. We're counting down to this jobs report on Friday. Torsten Schlock at Apollo reckons we're going to get a hot and solid number. We've got Fed speak. We'll talk more about that in a moment. Mary Daly is in no urgency to adjust her rates, but sees 3 rate cuts as a baseline. Gold did make it to a headline this morning, a new record this morning, although open interest is falling, and New York crude up 0.1%. The inventory slip. We'll have Bob McNally a little bit later on in the show to talk about geopolitical risk and supply issues in the oil market. But my next guest to kick off today's show writes this about the strength of tech. Under the surface, we're seeing corporate earnings, stock performance is weak outside of the IT sector. Not surprisingly, investors are favoring the safety of quality trades. Our favorite trade is cash and tech. The barbell. Maria Waitman joins me now, Senior Multi-Strategist at State Street. Maria, great to get you with me this morning. We've had this little bit of a shakedown in the market. You talk about what's going on under the hood. I would put it to you that these equity markets, Maria, have traded with a certain amount of impunity to a higher for longer narrative, and that's just been tested. Good morning.
Yes, good morning, Manos. And I think it's really, it's really interesting to think about equity markets, right? Kind of almost parallel narratives running. One is that macro narrative, which is soft landing, inflation coming down, growth is still okay. Central banks are going to cut probably 3 times this year. Rate cuts are coming, so volatility is low, and that's supporting equity market. So that's your kind of positive story. But then under the hood, you get all these micro stories where we're seeing layoffs, earnings coming down, banks are not lending, kind of manufacturing slowdown, China slowdown, and that's really kind of pulling earnings down. So you have this macro and micro conflict. And on the macro side, that's supporting momentum. Stocks are rallying, but if you look underneath, it's actually quite a select group of stocks as running. So it's still tech-led, it's still quality market cap, like large cap-led. So that's the story for us. So it's really about selectivity.
So this macro-micro conflict that you talk about, are you upping the amount of cash that you have, Maria?
Sorry, can you?
Are you raising the amount of cash? You talk about the barbell approach that you have, which is in tech and cash on either side. My question to you is, are you raising the level of cash that you have in the portfolios at the moment?
That's a good question. I think yes, we'll probably raise cash. And yeah, so there are not much else we like. So cash investors are already overweight. The tech stocks quite substantially. That's a big position they're running. Everything else, I really struggle to find what else do I like. So yeah, I think you're right. Allocating a little bit more to cash makes sense.
There is this narrative out there that positioning is not stretched, that there's no extreme mania in these markets. Would you agree with that?
I think, again, on average, it's absolutely right. It's not stretched. The position in equity holdings are not as extended as we've seen in the past and in the previous so-called bubbles. But if you look at tech specifically, yes, our kind of estimates of investor positioning through our custodial holdings in tech sector, it's the highest outside the tech bubble. We haven't seen bigger position in tech. Then the big question is, does it make sense? I mean, perhaps, given that tech sector is so much more profitable than other sectors, it's so much more reliable, and kind of now we're kind of tapping into the new source of revenues with AI kind of excitement. So yes, tech holdings are as extended, I mean, more extended than we've seen outside tech bubble, but perhaps that's understandable. Other sectors, other regions, not particularly extended.
Maria, you talk about the macro versus the micro, and I just want to revert back to the macro, because one thing that did stand out for me was your call on recession. Now, it's interesting that I've had you on today. I've had UBS, Banu Baveja with me yesterday, talking about the tail risk, the fatter tail risk that is underpriced in markets is a slowdown in growth, which is not the consensus narrative. There's no dramatic consensus narrative for a slowdown in growth. You actually used the word recession. We expect the US to slip into a recession. I'd call that slightly contrarian at the moment, no?
I think it's quite a nuanced call. So we think that current economic situation in U.S. is actually quite robust, which means that it's difficult for Fed to cut interest rates. I think three cuts is a stretch. And the longer the interest rates stay higher, then we will begin to see problems. And the way we see problems coming along is through kind of financing channel. We already see borrowing funding costs increasing quite substantially, particularly for smaller companies. So there, I mean, I quite like to look at things like net interest expense to EBITDA, and that's the highest in a decade for smaller companies.
But when does that bite? When does that bite? Does that bite in the back half of this year, Maria? And then, what is the consequence of that? Because if we fall into recession, then Bano Baveja can go for lunch because he's calling for 5 rate cuts in 2024.
Well, I think that's quite punchy. But I think it's already biting for a lot of companies. I mean, if you think about Q4 earnings report, I think it was quite hard to find many reports when companies didn't talk about layoffs, didn't talk about difficulty to margin squeeze and difficulty to pass higher costs. And we see that in companies with a lower margin. So things of your consumer staple companies where margins are quite low, they're really struggling. They're really struggling to pass higher costs to consumer. So I think probably parts of the economy is already in recession. I mean, fortunately, U.S. has a huge service economy, which has supported by labor market, by fiscal impulse. So there are still parts that are supported, but arguably that's on borrowed time as well.
Okay, so focused on the net interest to EBITDA. We're seeing the oil markets strong, robust. Geopolitics is in part fueling that. I would say that actually there's very little geopolitical risk, maybe a buck. Bob McNally puts it down as $1 geopolitical risk, and the rest of it is a tightening market. When you look at energy markets, there's a macro impact and there's a micro impact. Dissect it for me.
I mean, oil is challenging because normally you would think about demand forces are quite similar between energy and materials, so oil and kind of industrial metals. And we're seeing very big divergence between prices of, say, things like iron ore and oil. So to me, actually, there is a lot of kind of supply and geopolitics that's driving oil prices. So that's a big concern. And I mean, increasingly, we're seeing that coming up and up. So I do worry about geopolitics and kind of market nervousness around it. So maybe in reality, there is not much oil pulled out of the market, but market is really worried about it, and we see kind of premium paid for oil as opposed to kind of other commodity sectors.
Indeed, and we now have the earthquake, the unfortunate earthquake in Taiwan to deal with, and that certainly can have reverberations around the supply chain, potentially within chips. Maria, thank you very much, Maria. Joining me this morning, setting the agenda, the macro versus the micro, is the trade from Maria Waitman. Other stories trending on your Bloomberg terminal this morning. U.S. regulators led by the Fed have blocked tough global climate risk rules for U.S. banks. That's according to people familiar with the matter. European central bankers have been pushing the Basel Committee to require lenders to disclose strategies on green commitments. In closed-door meetings, U.S. officials cited their narrow mandate and the concerns that the Basel Committee were overstepping their purpose. Reuters reports that Disney has secured enough shareholder votes to defeat a challenge against a board mounted by Nelson Peltz. Elon Musk says that while he doesn't own Disney shares today, he would definitely buy it if Peltz was elected to the board. Donald Trump has two co-founders of his newly public Trump Media and Technology Group. Trump claims they set the company up improperly and shouldn't get any stock in it. Trump Media shares plunged less than a week after going public. And the comedian Jon Stewart says that Apple told him not to interview antitrust enforcer Lina Khan when he was still working for the iPhone maker. Apple currently faces a suit from the Department of Justice. Before returning to Comedy Central's The Daily Show this year, Stewart served as the host and executive producer of Apple's streaming services. The problem with Jon Stewart. Coming up, it is the worst earthquake in 25 years. It hits Taiwan. We get the details next. And the presidents Biden and Xi talk over the phone in their first one-to-one exchange since November. From AI to Russia to drugs. We'll have the details on Bloomberg.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry, meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hey. My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Significant. Just give us a concept of the supply chain interruption or the risk of supply chain interruption here.
That's a very good question. We don't quite know the full impact yet. From the prima facie, it looks as if they took a precautionary step. They underlined to us that it was a procedural action. They've previously suspended activities or modified their activities at their fabs when there have been typhoons, for example. And I think that this is a sort of behavior you expect from a major technological producer whenever there is an event like a typhoon or an earthquake. That said, Barclays has put out a report saying they're going to have to need to monitor developments. It's possible that what's happening on the east part of the island, where we've had trains disrupted, where we've had highways blocked and roads cave in, that could lead to some sort of supply chain impact.
Okay. Adrian, stay safe, and thank you for reporting that. It's Adrian Kennedy in Taipei on the earthquake. Quick snapshot of what's going on in commodity markets. You've taken out records in gold. You've had copper trading above $9,000 and solidly above there. Crude remains a bid up 0.25%. Gold comes back from its new record high. We've got a fall in the open interest there, so maybe a little bit of short covering going on in gold. Good morning from New York.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Brief. I'm Manus Cranny in New York. The U.S. and China are ramping up their communications. Presidents Biden and Xi getting on the phone for the first time for one-to-one discussions since November. When the Treasury Secretary, Janet Yellen, heads to Beijing this week, Anne-Marie Hordern joins us in the studio. So we're in full election mode now, aren't we? Or am I being too skeptical? And this is about pragmatic steps to rapprochement with China?
I think it's both. It's pragmatic steps. These two individuals, when they met in November in California, said that they were going to want to keep communications open, whether that's things that they can agree on, like AI, like climate, military to military communication. They wanted to make sure that they can keep the line of communication open. At the same time, it is an election year. And I think also from Xi Jinping's point, he does want to put a lid on the tension and acrimony you see from Washington and Beijing. He just had all these executives.
I was going to say, he's just had Pfizer,
town.
he's just had a bunch of CEOs in across the door to go welcome, and that's all about FDI.
All about FDI. It's at, what, a 30, 40-year low. He needs to get that investment back in, and he needs to revive his own economy. And at that point, you don't want to have a tit-for-tat with the United States.
Yeah, but then this is where trust comes in. So we've both looked at this story, and I'm curious to get your take on this. The Chinese media are focusing on the following line: don't flip-flop, don't stir up trouble, and don't cross the line. I wonder would he say that, would he say that to the other prospective candidate that's running for presidency?
I think he would. I think what he potentially, it could be a number of things, right? He's talking about with that line. Is it about Taiwan, how the U.S. sometimes says two things at the same time when they're talking about Taiwan? Or is it also about the fact that the United States is talking about, Secretary Yellen has been talking about this, and she's preparing to go to China as well, the overinvestment, the capacity that China has, the subsidies that they use in their market, and what many say dump on the global market. And at the same time, they're going to the WTO, China that is, with a complaint about the United States' Inflation Reduction Act and their own subsidies and protectionist measures. And potentially that's what Xi Jinping is getting at there with that line.
And then, of course, we've got the Wall Street Journal. Yellen proposed to travel to China. We've got an entourage traveling to the Middle East, we understand as well. But Yellen's preparing for China. What will be the objective of that? What will be the upside of that?
Well, this is really going to be about what she has been talking about recently. Most recently, she was on a domestic pitch at a defunct solar facility in Georgia, and some of these issues that are about U.S. jobs and the fact that because of cheap products coming out of China, they're usurping the U.S.'s own industry. So that is going to be...
Is this about onshoring, or is this about, again, a political narrative? She says in this story, she says, we don't want to be overly dependent, and they want to dominate the market. So this is, again, a domestic message with a global pitch.
Exactly, but it's an election year. And this makes sense from this administration to want to do that, especially as they try to win some of these union votes. They are trying to push this EV electrification of the grid, and all of that is coming out of China. She also says in this story, quote, people like me grew up with The View. If people send you cheap goods, you should send a thank you note. That's what standard economics basically says. I would never again say, send a thank you note.
Message from Anne-Marie Horder in there. I'll never send her any cheap goods. Anne-Marie Horder on the political narrative. You'll catch her in Bloomberg Surveillance with the team in 30 minutes. This is Bloomberg.
Ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to try to come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger is off for the week. Here's what you need to know. The Fed's Loretta Mester and Mary Daly say they still see a trio of rate cuts this year, although they're in no rush. Chair Powell is due to speak later today. Presidents Biden and Xi speak for the first time since November. AI risks, Russia, and fentanyl, all on the agenda. Taiwan is hit by the worst earthquake in 25 years, killing at least 7 people and disrupting some chip production. We have a live update from Taipei. So these equity markets at the moment are shaken by the rise in yields. They're dragged lower on the NASDAQ by Tesla. There's a sort of a real reckoning here. JP Morgan have said equity markets have so far managed to ignore the pivot within the pivot. The Goldman Sachs unprofitable basket dropped by 3%. Positioning is not stretched. I've just had State Street reaffirm that to me. There is the macro versus the micro. There is a lovely line coming out from Goldman Sachs. They're talking about their prime book. This is important. We have the largest short selling in 6 months, and the largest moves were in TMT stocks, making up 75% of the selling pressure in the prime book, according to Goldman Sachs. We're down 0.3% on SPOOs. MSCI carry the weight of the earthquake in Taiwan around the Asia Pacific, the 7.4 magnitude. TSMC is at the bottom of your screen now, down 1.25%. We understand staff have been moved from production facilities within Taiwan Semiconductors. Out of that, there may be reverberations in the supply chain. Roll it over, have a look at Intel. They've been a truth and reconciliation moment with their foundry business, their chip-making business. Stock down nearly 5% at the moment. The foundry business losses ramp higher by up to $7 billion, up from $5.2 billion, and will not break even until the year 2030. Roll it over, have a look at the bonds. The bears had a go. The vigilantes are still asleep is what I would say to you. We'll discuss that in just a moment with my guest, Blake Gwynn. You've got yields making the high of 2024, up another couple of basis points this morning. You had the biggest two-day rise since the start of February. We're counting down to the jobs report. Mary Daly and Loretta Mester, they're still using the rhetoric of 3 cuts, but do they have the conviction? Gold off its record highs, 22.71, and oil is bid up 0.25%. We'll catch up with Bob McNally in a short time to discuss the geopolitical premium in the oil markets. So it is a big week for Fed speak. 2 officials say that they see 3 rate cuts as a reasonable baseline for 2024.
I continue to think the most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence.
The labor market is still going strong and growth is going strong. So there's really no urgency to adjust the rate. We need to be sufficiently confident that we're on the right path of rebalancing the economy and bringing inflation down to 2%.
Joining me now is Blake Gwynn, head of U.S. rate strategy over at RBC Capital Markets. So 2 voters, Loretta Mester and Daly, both sort of still hanging on. Are they hanging on by their fingernails to 3 rate cuts? Good morning.
Morning. Yeah, I mean, I think, what you say, hanging on by their fingernails is absolutely right. I think they have this kind of story that they're going with, that the January inflation data, they came in very hot. It was essentially like a one-off idiosyncratic kind of fluke, and they just need some proof that that's actually the case. So I actually think there's a lot riding on this next CPI print coming up. Give us a little...
Do you think it was a fluke?
Yeah, and I think that's pretty much consensus as well. I mean, I think people do agree with the Fed that it's coming down, but it just puts a lot of risk on that March CPI report, because I think it's really kind of put up or shut up time for this bump in the road narrative. If it doesn't come down...
Oh, don't worry. Transitory lived for quite a long time. But you say it's either put up or shut up in terms of the idiosyncrasy of
the bump in the road narrative that they've been kind of selling, the last month or so.
How nervous were you over the past couple of days when you saw bond yields up by 15 basis points?
Yesterday morning, I really thought, we were going to take off there for a second. I mean, we've come through some technical levels. I'm looking at your chart here with the 10-year yield at 437. 435, I think, was a level a lot of people were looking at. When we kind of got through that, we tried to break it in February. We tried to break it in March. Didn't quite make it over the hill. And so when we broke that pretty solidly yesterday morning, plus the fact that I think a lot of these momentum type accounts are involved, are getting short, I really thought we could, be in for a pretty quick move higher. But so far, we kind of stabilized. I think we saw some good demand come in yesterday afternoon and, keep that run from occurring, at least in yesterday's session.
So if I said to you, the bears have had a run, but the vigilantes are still asleep, what would you say to that?
The bond vigilante story, we had a run of that, August, September of last year, you remember. Yeah. And I think it's been coming up a lot in conversations recently. I think, that August, September term premium kind of driven run, it's been invoked a lot in conversations I've had with clients over the last few weeks. So it's certainly on people's minds. But I do think the way that played out should have calmed some of those fears about supply. If you kind of remember what happened back in August, we did get an announcement from Treasury that really surprised a lot of people as to the amount of supply that was coming. They had started, at that refunding meeting, started increasing the amount of bonds they were issuing. We think that's pretty flat from here. We don't see them increasing those auction sizes again until 2025. So you at least have that kind of off the table. Now, the overall issuance is still very high. Mm-hmm. We're still running high deficits, so I think it's still on people's minds. But I think markets showed back then that they can handle it. And, a month after the kind of term premium scare, supply scare, we were right back down to low yields into December. So
it's amazing how certain narratives build in momentum and then fade. Jay Powell spoke last Friday. The world was unable to trade on Jay Powell's narrative last Friday. We're counting down to his speech today and jobs data on Friday. So there are two quite important narratives. What do you think happens this week? Are you looking for a hot jobs number? Do you think that Powell in any way changes his rhetoric from last Friday?
So I think, if we look at what we saw last Friday, I think it leaned a little bit hawkish. But I think an important thing about Powell, and we also saw this with Waller, is that even though there were elements that were read as hawkish, they're talking about patience and being able to, go into the first cut very carefully. But neither one of them are necessarily precluding a cut in June. They leave that possibility open that we are going to see inflation continue to develop the way that they expect, and that they will be able to cut by June, because they mentioned, they just need to see a couple more CPI prints. We get 3 by that June meeting, so they will have a chance to see enough data to start cutting by then. So even though it reads a bit hawkish, I don't think it precludes a cut in June. As far as NFP this week, I think one thing that was very interesting in the press conference with Powell is that he put this kind of asymmetry on the labor market data, saying that, if we get good labor market data, that's not enough to keep pushing those cuts out. But if we get bad data, it could certainly pull them forward. So I think there's a bit of asymmetry where if we get a weak print, the markets probably start pricing in more cuts at the front end. If we get a strong print, we're probably kind of pinned at the front end, and really what you get is the back end raising. So I'm biased towards steepeners.
Okay, and I think that, again, that seems to be a building consensus. Looking at the JP Morgan survey, and I was sort of struck by this morning, for positioning. JP Morgan have the biggest, in their client survey data, the biggest outright shorts since January the 1st, which is, okay, we've had a little bit of a bump in yields, a little bit of a sell-off in prices in the past couple of days. How would you describe positioning?
It's kind of funny because I was a bit surprised by that as well. Just in a lot of my conversations, particularly more in the real money type of space rather than the fast money hedge fund. But a lot of my conversations have suggested that they still remain somewhat long, maybe a little bit less long than they were at the end of last year, even coming into January. But I think they still remain in those long positions. And outside of that, I think people are fairly neutral on rates right here. I think what people have kind of shifted to is that without this high conviction view on where rates are going, we're in this kind of hold period now. You had the big hiking cycle. Now we're just waiting for the cutting cycle. I think people have kind of moved away from those high conviction directional views. They're looking for spots to add carry. or to find ways to kind of eke out some returns without taking those big views. So I think people are actually fairly neutral on duration, on the direction of rates right here.
And do you think that that permeates across credit and across high yield? Is that sort of neutral? Would you say that neutrality is pervasive, not just in sovereign?
Yeah, and I think one of the places we see it showing up a lot too is the vol space. So we've, a lot of the collecting of carry is people selling vol, and we've seen vol, come down quite a bit. Implied vol has kind of collapsed over the last month or so, and I think a lot of that's because people are just selling that, try to eke out some returns when you don't think there are going to be big directional moves in yields.
Okay, let's leave it there. I'm reminded of selling volatility and selling put options in 1994. It was great for a while.
It's always great until it's not.
Until it's not, and then you have a few margin calls. I can assure you, Blake. Thank you so much for being with us this morning. That is Blake Gwynn, my guest this morning on the bond markets from RBC Capital Markets. Let's just give you a snapshot. There was a blow up in yields yesterday. It was a global blow up in yields. Now, to a certain extent, U.S. yields continue higher for the third straight day. Let's see what Jay Powell says today. There's a small moderation in UK and German yields this morning in the market. Coming up, we're going to discuss the oil market. Bob McNally, founder of Rapid Energy, joins me on the scale of war premium in these markets. This is Bloomberg.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It is Bloomberg Brief. I'm Menace Cranny in New York. Oil is holding its ground. The rally ahead of the OPEC Plus meeting. Our next guest writes this. Rapidin has long asserted the oil market was too complacent about the Iran contagion risk emanating from the Gaza conflict. This week, that changed. Traders will begin pricing some risk the conflict will spread to include Iran. Bob McNally is the founder of Rapid Energy and longtime friend of the show. Bob, good to see you this morning. Contextualize this for me. We don't know how the proxies will react. We don't know what the reaction function will be from Iran. Give me the scale of geopolitical risk premium that has been imbued into the market, and how much is it underpriced? Good morning.
Good morning, Manus. So we are in an escalatory dynamic that until this week, the market is largely shrugged off. And the escalatory dynamic is largely between Israel and Iran. And at risk is the 25% of global oil, seaborne traded oil, that is produced in and flows from the Arabian Gulf. About 20% of LNG as well, by the way. That's the risk. The market has largely ignored this since early November, when Hezbollah said we're not going to open a second front. But it's coming back into the market. Why? Because Israel escalated by, for the first time, directly attacking an Iranian diplomatic facility. And Iran is going to have to respond in some form of commensurate retaliation. So the market is saying, wait a minute, whoa, this isn't just about Gaza or even the Red Sea, which is just a shortcut issue. This is about the threat to the world's strategic oil and gas supply and trade. So that's why we're starting to price in this risk premium.
So this is about the Strait of Hormuz. This is about a geographic shift. You think there could be a risk of a shift from the Red Sea to the Strait of Hormuz, and that, you say, the geopolitical risk premium at the moment is $1. So we're underpricing by approximately how much? What is the risk if there is a serious escalation to supply, Bob? You've seen them before, but we don't know the quantum so far. Where do you think this could take us to in oil prices on an escalation risk?
Yeah, so my colleagues and I, we've modeled, an interruption in the flow from the Strait of Hormuz, and it's also the oil produced in, like Abcake. It's onshore production facilities and the choke point, like all that. That's a $40. If that gets interrupted, that's a $40 rise in oil prices until we hit. It'll cause a recession. Now, Rapidan has had a 30% probability of that occurring. The market until this week was about 0%. It's priced in a little bit, but we think it's going to go higher. So this is a $40 delta if it happens with a 30% probability, according to Rapidan. The market just beginning to price this in. We think there's at least another $10 in upside, just as the market starts to understand the risk, not the actuality, but the risk of a disruption.
Okay, well, let's all hope that we don't end up there, both from a human point of view and indeed from a market and risk to the world economy point of view. Let's just step back. Let's just de-escalate ourselves a little bit for a moment, because I also want to know how tight this market is. 2 million barrels a day are off the market by OPEC+. Mexico are stepping back from their deliveries in terms of exports. I have a rebounding China economy. The Saudis are raising their prices there. Those three separate things coalesce to give me a much more solid floor in WTI at 85 and Brent at 89, or perhaps even squeeze this market into a deficit earlier than we thought?
We are definitely on firmer ground fundamentally, Manus, as you said. Big change from the fourth quarter. We're starting to see stocks draw onshore. There were expectations of big draws last quarter, didn't materialize. They're starting to show up now. Time spreads are moving deeper into backwardation. And so cracks, refinery margins are quite good. And so when those refiners come out of maintenance this spring, they'll be chasing those cracks, drinking in crude and producing gasoline and diesel. So it is a much firmer market. And Chinese macro, as you mentioned, readings, especially on the production side, the PMI side, manufacturing side, have been positive. So macro has been helpful. The fundamentals, as we see them, are firming up. Price signals are showing a tightening market. It's not a super tight market yet. We still have a good chunk of spare production capacity, 4 or 5 million barrels a day, depending on who you believe. But it is a market that is on firm fundamental footing, no question.
Do you think Prince Abdulaziz bin Salman would be happy with 90 and would welcome $100 oil? We've got the $100 oil notes coming back in. Leave aside the geopolitical risk for the moment, Bob. I know it's hard to disaggregate, but we're both conjecturing on a delta and a probability in terms of the $40 oil premium that you're talking about. But from a construct of a market at the moment, how real is $100 oil in the near term?
I think $100 oil is entirely real. It just requires a little more risk pricing on the true geopolitical risk, as we discussed.
Yep.
I think in terms of the Saudi leadership, though, you know, we've had this conversation many years now. I don't think they target a price. I really don't. They did that in the 80s. I think they're most concerned with inventories. Inventories not building too high or going too low, because that's what unleashes price volatility, and that's the enemy of OPEC Plus and arguably the world. So I don't think he's looking at 90 versus 100. I think it's all about our inventory is going to be stable. You know, Menace, the great debate this year is over demand. And demand has been the surprisingly bullish element here, even in Europe, which is on its heels economically. Gasoline demand quite perky. The United States, same thing. So I think the Saudis and OPEC, they have a very robust demand growth estimate, as we know this year, over 2 million barrels a day. I think they're looking at more the health of that demand forecast than any given price per se.
And there are many grey swans on that front. We just had the first conversations over the start of this week about a growth slowdown in the United States of America and indeed in the rest of the world. But there's two sides to every trade. With that in mind, then, of course, you will be in Vienna in June. I may well be with you. Do you expect any nudging of the 2 million barrels a day that OPEC Plus have held off the market? If we hold at these prices and if things continue, Bob, there could be a building case to release back some of those cuts.
Absolutely. I think a tapering of the cuts, so some small increase in production by those members that have withheld production, will be on the table when you and I gather in June in Vienna. However, our base case is they'll be cautious and wait until October before bringing those barrels back. As you mentioned, Manus, there are macro black swans out there. And I think they're going to be cautious in returning the oil. So on the margin, I'd give it a little bit to a little longer of an extension, but certainly, especially if we get to May, demand readings are strong, inventories are drawing still, I could definitely see some tapering starting then.
How uncomfortable is the White House with gasoline going higher? I mean, do they have SPR that they can release? They've sort of cancelled some of the buybacks. How politically uncomfortable, you have knowledge of the White House firsthand, how unpalatable are these gas prices at the pumps in an election year?
I don't know. We know the alarm bells are clanging inside the White House DOE. There's no question about that. So they're in emergency mode. Just last night, it was reported that they've ceased filling the SPR. So the refilling program they've been undertaking has been suspended because prices are moving higher. And they can do another release. That would be controversial since they depleted the reserve so much. But you can never rule out the steps, the lengths the president will go to fight high pump prices, especially in election year. What would be worse, though, is if they looked at restricting exports of gasoline and diesel. After the LNG pause, that would be a big blow to our allies. I don't think they'll go quickly there, but you have to watch that. You have to watch NOPEC coming out of Congress. But an SPR release, unfortunately, is on the table. The main thing, you can bet, they may not be public, but you can bet they'll be quietly calling their friends in Riyadh and Abu Dhabi, asking for more oil at that June 1 OPEC Plus meeting.
Quiet messaging. Well, there's a convoy of the administration going to the Middle East, we understand, from the political front. Who knows what else they will discuss when they are there. Bob, thank you so much as ever with your insight to the markets. Bob McNally of Rapid Energy. Quick snapshot of where we are on markets. This is the S&P 500 down by 0.2%. Again, just jolted by higher rates. But we've just had a conversation with RBC, the bond team there, and they are seeing real money come in and snap up these bonds at these levels. So you are just seeing a little bit of temperance in the bond market, 436, and the dollar is flat at 12.47. Good morning from New York. Coming up in the show, we'll give you the diary of what needs to be done for your agenda.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
This is Bloomberg Brief. I'm Manus Cranny in New York. Let's take a look at the rest of the day. What's in store? More economic data. The ISM Services hits the tape at 10 a.m. Eastern. The chair, Jay Powell, delivers his remarks at Stanford, 12 p.m. Eastern. Plus, more Fed speak throughout the day, including Raphael Bostic, Austin Goolsbee, and Michelle Bowman. You can never have enough Fed speak, can you? Now, Intel, we've been checking this price through the morning. We're down 5.1%. Their losses are deepening at the factory network, and it warned that the business may not break even for several years. Stellantis, on the other side, down 2.8%. JP Morgan sees revenues and volumes down in the first quarter, so they're keeping an eye on that. And Disney, what movie comes to mind when you see the word Disney? We're taking a straw poll here. Some say Frozen. That's what I think. Anyway, others say The Lion King. Anyway, Reuters reports that Disney has secured enough shareholder votes to defeat the challenge against its board, mounted by Nelson Peltz. Now, Elon Musk says he definitely would buy the shares if Peltz was on the board. So stock at the moment down at 0.6%. That is it for a Bloomberg Brief. Bloomberg Surveillance and the team will take you through the next 3 hours of programming, setting the agenda on Bloomberg. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to
be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The Fed is telling us that inflation is still a problem. It's going to be less rate cuts relative to what the market was expecting.
I think the Fed have been really clear that they're looking for progress on inflation.
Not only has the market moved away from a Fed cut in June, the market's not even fully pricing in the cut in July.
Actually taking no action right now is probably the best course of action for them to take instead of making a mistake.
They want to give the market what it wants in the form of easier policy, but the risk is overdoing it to the downside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market facing just a little bit of trouble in the last couple of days. The bond market sell-off continues, closing out Q1 with a 10-year yield very close to 420, 3 days into Q2, and we're looking at 440 on a 10-year.
And suddenly, stocks are waking up to this, and I think that was what we saw yesterday. Although, just to put into perspective, we were down 0.7%, which was the worst loss going back 4 weeks, which just highlights how few losses we actually have had at a time where everything seems to melt up.
The next stop for this market is Chairman Powell, addressing the market and the economy a little bit later on this afternoon. Take a look at what's happening with precious metals going into this. Gold just pulling back from all-time highs. Silver, a 5-day streak, a run of something like 7%. And a big question, I think, in the commodity market and elsewhere, Anne-Marie, the question is the commitment to get inflation back to 2%.
Well, exactly. Cameron Christ this morning writing that the Fed has never in its history cut rates when the economy is this good, never mind inflation. And then you look at commodities and you see that inflation uptick across the board. Bank of America this morning, Jonathan, upping their calls on Brent and WTI. And then when everyone's saying the Fed may cut in June, that's going to be peak driving season. Bank of America has $95 a barrel this summer.
Well, let's get to crude. Shock. I think we're all shocked. The U.S. cancelling the latest oil reserve refill plan. Here's the quote, keeping the taxpayers' interest at the forefront. I don't think any of us are surprised by the latest move.
No, the question is what more are they going to do, right? Basically, the idea here is they're not going to go into the free market and add to some of the demand they've had in the crude market to try to juice up prices. So are we going to end up with basically further releases of already depleted stocks of the Strategic Petroleum Reserve heading into an election season, given some of these pressures? A bigger question might be, will that matter for gasoline prices? Because refineries and barrels are two different things.
Right, and it takes time for that to trickle down, at least a few months. Potentially, though, they could put pressure on OPEC+. The group is meeting today. We're not expecting anything out of it today. But what happens in the next few months if we do this uptick in prices? The conversations I've been having, everyone debating the oil market, is whether this is temporary or this is truly dislocations in supply and demand.
Can we check out a single name as well, just before we run away? TSMC. Let's talk about what's happening in Taiwan. The biggest earthquake to hit Taiwan in something like 25 years, Bramo. That stock is down 1.5%.
And part of the reason why is because we just don't know how long some of the operations are going to be taken offline. And Marie, you've been mentioning this quite a bit, that this is a concern because so many chips are produced in Taiwan. What kind of supply chain disruptions could there be? I want to just read this one quote by a couple of analysts. Some of the high-end chips need 24/7 seamless operations in a vacuum state for a few weeks. Operation halts in Taiwan's northern industrial areas could mean some high-end chips in production may be spoiled. That, to me, is fascinating from two perspectives. One, how disruptive just even a temporary supply shock could be, but also how difficult it is to make these chips.
And TSMC is already moving staff around. And the issue is, to your point, we've been talking about this a lot, U.S. tech companies are so exposed to Taiwan. Now, this is just an earthquake, but everyone talks about the geopolitical risk, and we're still waiting on what the impact is, to your point, Lisa, of these high-precision semiconductors. One single vibration can destroy an entire batch.
Still assessing the fallout from that particular quake. We'll be catching up with Mandeep Singh of Bloomberg Intelligence later on in the program. To get things started this morning, equity futures pulling back by just 0.2% on the S&P 500. Looking to find some stability in the bond market with the yield tied by a basis point or two. 436.52. New highs for the year, Lisa, on a 10-year maturity, on a 30-year as well.
And people are wondering how high they could go. We heard yesterday this idea from Troy Gajewski of a 5% 10-year yield. I guess we'll see. Whether we're going to test the 450, I guess we'll see. Let's get those auctions started again. Are we going to care then? I mean, really, are we at the point where people are starting to perk up to this idea of longer-term inflation and say, okay, let's go, and how does Jay Powell respond to it?
Peter Chair of Economy saying that supply story, those supply dynamics will reassert themselves. Can we talk about inflation in Europe just briefly as well?
Yeah.
I had one question when that number dropped. Why aren't they cutting interest rates already? The inflation dynamics are very different in Europe compared to the United States, but the growth backdrop in Europe compared to America is just absolutely dreadful and has been for a long time.
You nailed this earlier when you said that they're conditioned by the mistakes of the past. They're conditioned by the fact that they did not get inflation right. They didn't act as aggressively as they should have. It's a good question. A lot of people have been talking about this. This was the predominant thought, was that Europe would cut first. Are they actually in a cutting cycle that the U.S. cannot be in? And what does that mean for the euro? We talked about parity calls. We talked about all the weakness. Let's see if that starts to really come to the fore.
And can they go without the Fed joining them? That's another question as well. Euro right now against the dollar, 107.69. Coming up this hour, Margie Bittal of Allspring on fading bets for a June rate cut. Pierre Ferragu of New Street as Tesla disappoints. And Gilles Moak of AXA ahead of new comments from Chairman Powell. We begin with our top story. Higher bond yields weighing on markets as investors lower expectations for rate cuts this year. Margie Bittal of Allspring saying this. Continued growth will suggest to the Fed that interest rate cuts are not needed in order to ensure the economy continues to advance. Many signals suggest that while inflation may continue to decline, it may stabilize at levels well above their target of 2%. Margie Bittal joins us now for more. Margie, when you look across the commodity market, you look into fixed income, do you think we're beginning to question the commitment of the Federal Reserve to get inflation back down to 2%?
Well, I think the ability to get to 2%, frankly, is out of the Fed's control. But it seems that as we see the economy continue to be very strong, it doesn't need rate cuts to continue at these levels. And also, it looks, there are signs here or there that although inflation's come down, other parts of the inflation picture look as if it's stabilizing at levels significantly above 2%. So the Fed really doesn't have much of a case right now to cut rates.
Is that a reason for bond yields to remain elevated? And if that's the case, Margie, we've got to figure out this evolving relationship between bonds and equities. It's a different story at the back end of last year compared to the start of this year. Just what is the relationship as yields start to disrupt equities a bit in the last couple of days?
Well, it's really hard to see how a yield on the 10-year of a 4.3 to a 4.5, even higher, can have much effect on the real economy when you have inflation clocking along at, say, 2.5%, 3%, something like that. It hasn't affected economic growth so far when we've had periods when it's dipped up a little bit. So I think I hate to say it's irrelevant, but honestly, it looks irrelevant. We had the Fed raise 500 basis points in short rates, and the economy has moved along with only one quarter where we had a negative quarter.
Are you rejecting the idea, Margie, of long and variable lags, essentially?
Well, you know, they're so long and so variable, they're really meaningless for an investor to make a position out of it.
Which raises this question of whether people have perhaps tied the idea of bond yields to stock returns a little bit too closely. Do you take signal, or do you say it's noise that yesterday stocks fell in tandem with bonds?
Oh, I think that particularly the tech sector got off to such a huge start. It just needs to take a little rest here and maybe have a little bit of a correction. And there's always trading money that's looking towards, will the Fed cut 1, 2, or 3 times, even though that's diminished. So I think it really is more noise. Economic growth was strong. It looks, the signals are in the first quarter, it's also going to be strong with profit margin maintaining. So that says we're going to have another good market this year.
Margie, you've nailed it over the past couple of years. Traditionally, you really made your name in the bond market, and recently you've been going into stocks pretty much, not exclusively, but definitely more so than into bonds. Are you continuing on that path? Do you feel like that is the trade of, frankly, the next 5 to 10 years, just simply because rates cannot come down so much from where they are now?
I don't know if I could go 5 to 10 years, but certainly for the next year or so, I think we'll get better returns from equity on balance. I mean, even high-yield bonds, which is the best part of the bond market, in my opinion, the yields are, say, 6.5 to, say, 7 3/4, which is really a pretty low hurdle rate for equities to do better. I think the defaults will be very low in high yield, so you have to keep that extra yield. But really, when you look at total return, it just says with the uncertainty, you're better off in equities this year.
Margie, what do you think we're going to hear from Jay Powell today? Do you think he's going to be shifting potentially towards the Raphael Bostics of the Fed or those of, say, Mary Daly and Loretta Mester?
Well, I think he's really, he has, as I said, a real problem because they sort of telegraphed they were looking to cut rates. And when you look at the economic conditions, it really doesn't seem to be justified. So it's almost as if he's, like the rest of us, looking at the market for signals on what he ought to be doing rather than having a game plan that's where he has a better plan, say, than investors do. So
Mark, up until recently, the market was saying everything's awesome. You just said something quite remarkable. You like high yield as the best part of fixed income. Why is that, Margie?
Well, because I think the risk is low because the economy is growing, and actually high-yield bonds are telegraphing that because yield spreads have actually compressed a bit, saying that they're not too worried about defaults. And really, everything look at the economy says, you know, commodities look as if the economy's strong, and that's really the best backdrop for high yield, not so much the Fed making a quarter, half a point change in short rates, but what are the economic fundamentals that these companies use to cover their debt service.
Margie, this is really important. You see tight spreads as a reflection of strength and not of complacency. Why is that?
Just because the facts say the economy is in good shape. I think what really has people off is we had the Fed raise short rates 500 basis points, and we didn't have a recession. So it just seems as if the market isn't right. We should have had a recession. The Fed comes to our rescue, cuts rates, and the economy goes off. We really didn't have that. We've had a few little pauses here, but I think it shows you that the economy doesn't have any imbalances, and we should, I think, grow surprisingly well this year. So another year of economic surprises, a surprisingly good equity market.
We've been talking about the balance of risks, and I expect that we'll hear some of that from Fed Chair Powell today in a speech at Stanford in tandem with the CEO of Google and Alphabet. I am curious whether you think that the biggest policy error right now is not tackling inflation enough and the idea of inflation becoming more entrenched and being higher for longer in a way that people are not prepared for.
Well, I do think inflation is going to be higher, maybe only a smaller amount, and for longer because of all the buildup that we had with very low interest rates, with deficit financing. I think that really bakes into the cake an inflation level above that 2% for the foreseeable future. But that doesn't mean we have a bad economy, and it doesn't mean that corporate profits will go down. In fact, that's a signal to me they can maintain profit margins if you have some inflation helping.
Interesting. Margie, wonderful to hear from you. Margie Patel there of Allspring. Her view on this market, equities and bonds and in fixed income, high yield, spreads at multi-year tights, there and thereabouts. See that as a reflection of strength and maybe not a reflection of complacency, which is what we've heard around this table a few times. Look, if we can stand up, if the broader economy can stand up to interest rates of north of 5%, that's one thing. Can pockets of the economy continue to get by? And I'm thinking of commercial real estate. Moody's out yesterday. This is the quote from Moody's. I know you saw the same thing. The office stress isn't quite done yet. Vacancies rising to a record 19.8%. If you're going to see higher for longer, can those parts of the economy really stand up to that story for much longer?
And does it matter? Right? I mean, I guess that's the other question, because we've been talking about the pockets of the economy that have been really hit much harder than others and been left behind. And I'm talking about commercial real estate. I'm also talking about segments of the income population that don't have the reserves to really tackle some of these issues, or people who don't own homes. To me, it remains to be seen, how much is the Fed going to cater to some of these pockets of concern and cut rates without necessarily putting inflation first? That is what we keep hearing from people. I would love to hear that from Fed Chair Powell. Please respond.
Are you willing to trade financial stability for price stability? Is that the question?
That could be one of them. Are you willing to trade potentially blowing out pockets of the population and reducing their chances for employment, reducing their chances for wealth and prosperity in order to target a certain inflation target? I don't know the answer to that, but this is a very socially conscious Fed, as you mentioned yesterday. And that definitely is weighing on them at a time where it does seem like Markey is correct, that things are all being, pretty positive, and we seem to be chugging along with rates where they are.
Chairman Powell, a little bit later on this afternoon. Equity futures right now negative by 0.25% on the S&P. Let's get you an update on stories elsewhere. Here's your Bloomberg brief with Yahira Hakez. Hey, Yahira.
Hi, John. Inflation in Europe inching towards 2%. Firming up prospects of a June rate cut at the ECB. Consumer prices rising 2.4% in March, a lower rate than analysts forecast, and down from a 2.6% read in February. Core CPI also eased at a faster rate than expected. ECB President Christine Lagarde has signaled a first rate cut in June, with much of the central bank's governing council on board with that timeline. Taiwan has been hit by the strongest earthquake in 25 years. At least 7 people have been killed and more than 700 injured during the 7.4 magnitude quake on the east of the island. Rescue workers are scrambling to find more than 70 people who remain trapped after the earthquake leveled dozens of buildings. President Biden and former President Trump both added to their delegate counts last night. 4 more states held primaries on Tuesday, and the presumptive nominees easily won in New York, Connecticut, Rhode Island, and Wisconsin. Trump picked up 78 to 84% of the Republican vote, while Biden took 83 to 91.5% on the Democratic side. That's your Bloomberg brief. John?
Yahira, thank you. Up next on this program, Biden holding talks with Xi.
The teams have been working a lot since November, and both presidents thought that now, a few months later, this was a good time to kind of check in with one another, see how that's going, discuss the future.
Discussing the future in China, Treasury Secretary Janet Yellen heading to China. This in Chinese state media, the biggest threat to economic globalization, the United States. Did you see this?
Again, all of this is so rich. Yes, I did. It's just, really, really.
Amber Curran weighs in up next.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Counting it down to payrolls Friday, 214 is the median estimate in our survey. As we often say, that is a moving target. We get more estimates, that's going to shift, but at the moment it's climbing, inching higher. From about 200k in the last week, just inching higher to about 214 right now. The previous number, 275. Equity futures on the S&P 500. This Wednesday morning, negative. We're down by 0.2%. Yields creeping a little bit higher by a single basis point, 436.32. Under surveillance this morning, Biden holding talks with Xi.
The teams have been working a lot since November on fentanyl precursors, on climate change, on economic practices. So there's been, on artificial intelligence, there's been a lot of staff level work, and both presidents thought that now, a few months later, this was a good time to kind of check in with one another, see how that's going, discuss the future.
Here's the latest this morning. President Biden, China's Xi Jinping, speaking by phone in their first one-on-one conversation since November. The White House calling the conversation, quote, candid and constructive. The president's discussing everything from TikTok to military cooperation. The phone call coming ahead of Treasury Secretary Janet Yellen's trip to China later this week, her second trip in just 9 months. Bloomberg's Enda Curran joins us now for more. Enda, based on how that call went, what's on the agenda for the Treasury Secretary?
It seems industrial overcapacity is a theme that's emerging this week, John. That came out in the call between Biden and Xi that you were just mentioning there. Some analysts taking from the call, by the way, that there might even be some U.S. action coming on that on this side of the election. Treasury Secretary Yellen will go to Guangzhou, that's the heart of China's manufacturing and industrial base, and then go up to Beijing. And it's expected that she will be raising concerns. Last week she went to a solar panel factory that was forced to shut down in Georgia as an example of the complaints that the US have where Chinese industrial capacity or exporting cheap goods is hurting the global economy. So that seems to be one theme that is emerging from the Yellen visit and from the Biden-Xi talks. But also, let's not forget, it's also about putting guardrails and stabilising the relations between the world's two biggest economies.
Ahead of that trip, she tells the Wall Street Journal, people like me grew up with the view, if people send you cheap goods, you should send a thank you note. That's what standard economics basically says. I would never, ever again say, send a thank you note. This is a shift from Yellen from the start of the Biden administration. She wasn't a total hawk. What has changed in terms of how Janet Yellen views China?
Absolutely right. The Treasury Secretary has travelled a journey on China, Anne-Marie, and this speaks to the point of where US politics is right now, the bipartisan hawkish approach to trade with China, and this is why, for example, there's an expectation now that there might be more steps coming in terms of what they can do to tackle oversupply or excess capacity from the Chinese side. But let's not forget that China's pushing back against this as well. For example, in that readout between Biden and Xi, the Chinese readout made it clear that they will not sit by and do nothing while the US continues to put controls on Chinese technology companies, for example. So there's a clear pushback there. And they also made it clear that putting sanctions on Chinese companies isn't de-risking, it's creating new risks. So this is not a one-sided thing, even though Ms. Yellen is expected to raise these concerns. And as you say, she's certainly entered a hawkish camp. China's pushing back too, making clear that it's not going to take this economic fight lying down.
China state media really focused on one line she said, according in this meeting. He told Biden, don't flip-flop, don't stir up trouble, don't cross the line. When you look at the two readouts from both countries, did they agree on anything, Enda?
I think there's commonality there on sort of the low-hanging fruit, so to speak. Modest cooperation on AI, some cooperation on climate change. Clearly, they're working for some cooperation on the narcotics control, Anne-Marie. So there are areas where they're coming together. And there, of course, I think there's a broad theme as well, by the way, that we're 6 or 7 months out from the US election now. It's kind of time out. China won't really want to go too deep on a strategy with the US this side of so close to an election. But all of that said, none of the underlying problems have been solved. I mean, even as we have this talk of cooperation, we just spoke about the Treasury Secretary going to Beijing this week with a laundry list of complaints to bring to the Chinese government. And of course, within that readout between Biden and Xi as well, Biden raising concerns over China's support for Russia, China's activities on the South China Sea, and so on. So it's about guardrails, about stabilising things, but it feels more like time out. None of this has really been resolved.
And bear with me here. But as I read about all these calls, I'm wondering, how does this go down? Does someone say, I really need to talk to you. I'm having a really hard time with my economy. Let's get this going. How does it sort of transpire? Who has more leverage at this point economically as you have these discussions and these, tit for tats and raising concerns? Maybe they've been raising concerns for a long time. Do we have a sense of what the catalyst here is?
I think last year when they had that meeting in November, Lisa, there was a feeling that the US had the upper hand. The US economy is going gangbusters. China's economy, much less so. But importantly, sentiment towards China's economy from foreign investors, especially US investors, in the doldrums. Now there's a feeling China's trying to tilt the focus back towards its economy, stabilize things. And remember last week, President Xi Jinping holding that last-minute meeting with US CEOs. They are clearly trying to get US business and investors engaged again. So there is a feeling that at least on the economic side of things, the US has the upper hand, given the strength of the economy here. China, of course, is looking for investment from the rest of the world, so they are trying to get that back on an even keel. But that's really where I think that's maybe the only part where the US does have leverage. Elsewhere, we had a poll out this week, polling nations in Southeast Asia, indicating that popular opinion there has swung towards China for the first time away from the US, and that speaks to the challenges that the US has on the global stage, be it Gaza or be it, of course, Ukraine. So some leverage on the economic side, but elsewhere, the US has plenty of challenges in terms of wooing the global south when it comes to China.
Massive challenges. Can we just finish on policy and the prospect of getting tariffs sometime soon? And we've been waiting for a decision on Chinese EVs. I think BYD and Focus for many. When is that decision going to come?
No real hint of the timing on that, John. There was a nod to the tariff discussion in that Xi-Biden readout yesterday. We don't have much more than that, other than, broadly speaking, people expect this hawkish trade policy to continue. Obviously, industrial oversupply is a concern. EVs are part of that. It'll be very interesting to see what comes out of Yellen's trip to Beijing later this week.
And thank you, sir. Great to catch up with you, sir. Appreciate the update. Ender Curran there of Bloomberg down in Washington, D.C. Let's check out shares of Tesla. Yesterday, down by close to 5%. This morning, negative by something like 0.9. The team here at Bloomberg crunching the numbers. The share of the Chinese market over at Tesla going from 10.5% in the first quarter of 23 to around 6.7% in the first quarter of this year.
How much is just a pricing issue? We talked about this before, that a lot of the Chinese models are having a lot lower prices. Also, they're being supported and they're being pushed out there, and there's sort of this nationalist streak. Can Tesla continue to do well without the Chinese market, which is the biggest one for electric vehicles?
That market is hyper competitive. Pierre Fadigo of New Street Research on Tesla coming up very shortly, with the stock down by about 0.9% in the pre-market after falling yesterday by close to 5 percentage points. The broader market looks a little something like this in the equity market. Equity futures on the S&P 500 negative by 0.2%. Yields creeping a little bit higher once again by a basis point or two, 436.52. And in the commodity market, the rally continues. New highs for 2024 in the last 24 hours. 85 on WTI, 89 on Brent.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
2 days of losses to kick off at Q2. Your equity market on the S&P 500 attempting to prevent that from becoming day 3. Equity futures at the moment not doing that. We're negative by 0.2% on the S&P. On the Nasdaq, we're down by 0.35. The Russell, the big rotation you were looking for. Small caps did not work yesterday. Down 1.8% and down close to 3%, Lisa, in just 2 trading days. Small caps didn't work. Energy did. So parts of this rotation still held up.
Well, and that was very tied to the fact that energy prices were flying, and yet we got bond yields flying as well, which is part of the reason why we were saying yesterday, how much do higher yields challenge the rotation trade? Yesterday seemed to indicate maybe quite a bit. Then we heard from Margaret Patel, it's all noise. So we shall see. But yesterday, definitely not bonds very much in focus for a lot of these other sectors.
Well, let's get to the bond market. The 2-year, the 10-year, the 30-year. We're talking about levels that we haven't seen so far this year, going through the year-to-date highs. 436.52 on a US 10-year, up a single basis point. On a 30-year, we are back through 450. This idea that maybe we won't get any cuts this summer based on how strong the economic data has been. Now, strong economic data without inflationary pressure is one thing, which I think is the Fed's hope and dream. This market might be spooked by the prices paid component of the ISM, which is something you brought up a couple of times yesterday.
Although I wonder what triggered it this time, because people have been very good at dismissing every single data point. I love how people try to ramp up excitement for the upcoming information that we're going to get. For example, Pantheon came out we get ISM services today and ADP. This was the headline. ISM services and ADP employment reports are both deeply unreliable. So you still have people coming out and basically saying ignore all of these data points. So what triggered it this time? Because we've been getting this steady drip, and yet a lot of the Fed officials don't seem to be concerned and seem to say this is pretty much in line with our expectations.
Even 24 hours ago, we were looking at these moves in this bond market, in commodities, and we can check out crude right now. And equities were down by a couple of tenths of 1%. It was like a snoozy equity market in the face of what was developing elsewhere. You've seen the move in crude. Brent now approaching 90 again at 89.32. It's the move in precious metals that gets my attention over the last couple of weeks, though. All-time highs on gold repeatedly over the last month. Silver breaking out yesterday, and just fueling those questions. Those big questions we've all got, the commitment to getting inflation back down to 2%.
Are gold and silver better proxies for inflation havens than any other asset class, right? That's sort of the question that a lot of people are looking to. Or, and either way you cut it, or are some of these precious metals flying because industrial production is so great, and so people are having demand for them. Either way you cut it, it points to strength and it points to ongoing pricing pressure, and that maybe is causing people to really wake up to that idea a little bit more.
Let's get to the Fed speak. Under surveillance this morning, Fed Presidents Daly and Mester holding the line, urging patience before cutting rates this year. Mary Daly saying yesterday that 3 cuts is a reasonable baseline. Loretta Mester saying she wasn't surprised by hotter than expected readings to start the year, adding, quote, I need to see more data to raise my confidence. We'll hear from Chairman Powell once again, just after noon Eastern time, a little bit later on this afternoon. Anne-Marie, at the start of the year, 3 cuts from the Federal Reserve was hawkish because this market was at 6. 3 months later, 3 cuts of the Federal Reserve is dovish because this market has moved so much in the first quarter.
Right, and PIMCO coming out, and they've said they've already seen enough already, and positioning for the Fed to deliver fewer cuts than any other major central bank. We only just heard from Chair Powell on Friday, but within that time, we've seen rate expectations change yet again. So that's what everyone's going to want to be parsing through when he speaks today. And of course, it comes ahead of jobs numbers on Friday.
It's kind of laughable, Lisa, how much the market has moved and how little Federal Reserve officials have moved.
Well, basically, the market's not really listening to the Fed anymore. The market's looking at the data. And the problem is the data is incredibly confusing, as we hear from a lot of people, and you can kind of paint your own narrative. What I'm looking for is Chair Powell is speaking at 12:10 p.m. Eastern at Stanford on the West Coast. Right after him, Sundar Pichai, the CEO of Google and Alphabet, is speaking. And I think that this pairing is fascinating because these are the two prongs of the market so far this year. You have monetary policy, and then you have the AI hopes and dreams that are going to revolutionize productivity. How much do they talk to each other at a time where really people can't get these stories straight? This, to me, has been sort of the framing narrative for a year. It's been highly confusing.
The supply side hope and dream of the chairman of the Federal Reserve. You might hear more on that a little bit later. Let's get to our next story, a serious one. President Biden ramping up criticism of Israel's campaign in Gaza after military strikes killed 7 aid workers. Biden saying in a statement, quote, Israel has not done enough to protect aid workers trying to deliver desperately needed help to civilians. Comments also coming from World Central Kitchen founder Jose Andres, UK Prime Minister Rishi Sunak, and Australian PM Anthony Albanese. The pressure ramping up in a much bigger way.
Absolutely. And what struck me about this Biden statement is that it was in black and white. Israel has not done enough. It wasn't leaked to the press. This is tough. This was clear language from the President of the United States. We should note 1 American was killed in that hit as well in Gaza. But at the same time, reports that the Biden administration is pressing Congress for $18 billion of the sale of F-15 jets to go to Israel. And this is what takes individuals within the Democratic Party take issue with.
That's the latest on that front. We'll continue that story. Need to give you an update on the deadly earthquake in Taiwan, striking overnight, killing at least 7 people. The 7.4 magnitude quake, the strongest in 25 years. Companies for the Advanced Chip Making Hub assessing the damage this morning. Taiwan Semiconductor saying it has moved staff out of production centers. The company is a major supplier to companies like Apple, Nvidia, and others. Taiwan is the source of approximately 80 to 90%, Lisa, of the world's highest end chips.
There are 2 stories here, obviously, the human story and just sort of this question of we hope that everyone is okay. And then there's the industrial side of the story, which is that Taiwan is such a massive center of production of this key asset that we use in everyday goods. What this highlighted is just how difficult it is to make these. The idea that vibrations could really throw production off, or not some sort of seamless vacuumed in kind of process could cause these to be destroyed. It just shows that it's going to be tough to move the production to Japan or to the US and some of these other areas.
If you read Chip Wars, I'm not sure if you've read that book, but literally the first few pages about how vulnerable the supply chain is because of where these factories actually are. Taiwan vulnerable to earthquakes and other epicenters for chip making as well. If you could pick out the worst places to put some of these companies, that's exactly where they are.
Yes, and the issue is, to Lisa's point, there is no substitute as of yet for these high-end chips. Now, we're still assessing how much is potentially going to be taken off market with these earthquakes, but to your point exactly, Jonathan, there's 2 issues. One is the physicality because of the fractures in the earth, but then also add in the geopolitical risk, which is why I think this is interesting. If you want to see the exposure U.S. companies have, this isn't a geopolitical risk issue with Taiwan. This has to do from an earthquake, but what if there was a geopolitical risk? That's the key question.
Still assessing the damage this morning. More updates throughout the program this morning on Bloomberg TV and on Bloomberg Radio. Take a look at shares of Tesla continuing to slide this morning. The company reporting its biggest sales miss ever, delivering just under 387,000 vehicles in the first quarter. The number far below the most bearish estimates on Wall Street. Pierre Ferragu of New Street Research writing this: we're less confident about timing, but remain confident Tesla will continue to grind share in the high end and expand in the broader market with the Model 2. Pierre covers Tesla for New Street with a buy rating and a price target of 280. I'm pleased to say that Pierre Ferragu joins us right now. Pierre, I want to start with a quote from a peer of yours over at Deutsche Bank, Emmanuel Rosner, who said this: beyond the known production bottleneck, there may also be a serious demand issue. How much of that number do you think was about the bottlenecks, the production issues that they've had in the last few months? How much of it was just a fall off, a big fall off in demand?
Thanks, John. So we were like really on top of the production issues, the fire in Berlin and a few other issues related also to the situation in the Middle East affecting the supply chain. And we were expecting like 410 to 420,000 units. And Tesla actually delivered only 380, 390. So there is a very, very significant shortfall that cannot be attributed at all to production issues. Now it's like it's a few tens of thousands of cars. What we've seen is that in the US, demand has been extremely, extremely low. Inventories have been building up much more than we were anticipating, and that despite significant discount activity on the inventory. So demand is really, really, really bad. And then I don't want to sugarcoat the quarter. Reality is that if you have supply issues getting you down here, but demand is still fine, then even if demand is slightly weaker, it shouldn't be affecting your deliveries at the end of the quarter. The fact that demand went below where delivery could be means that demand is extremely, extremely poor. So a very, very tough quarter, a very, very tough wake-up call for Tesla. Now, remember, it's winter. It's January, February, March. These are months that have been historically extremely difficult and very volatile, very unpredictable for the high end of the car market. For some reason, we've seen that in the past, in 2019, in 2018. Sometimes some brands really have barely any sales in January and February, and nobody is out in the market in Europe and in the US buying these cars. And Tesla doesn't have their own dealers. So when they get hit by an air pocket in the market like that, it's instantly visible in their numbers. So the thing I would say is I wouldn't overinterpret what's happening. Let's take a step back. Tesla gained 15 points of market share out of nothing in a few years in the very high end of the car market, in the premium car market, with a new brand, a new positioning, very unique, very differentiated cars. And from this 15% market share, now what we see is that Tesla is not going to gain to increase by 30 or 40% their volumes year over year anymore. The best we can hope in that segment is that Tesla keeps creeping up market share, go from 15 to 16 to 17 to 19% market share, and hopefully eventually towards 20%. But this is not going to deliver a lot of growth. The real growth opportunity for Tesla in the car industry now is actually expanding the product portfolio towards an entry price model, because that quadruples the size of the market in volumes for Tesla, of course, and that's the Model 2, what we call the Model 2, the next generation platform.
Just quickly here, Pierre, I am curious about whether your bullish call for Tesla is hinged on the idea that Tesla is not ultimately a car company, but it's more tied to some of the batteries and other products that are fueling some optimism that its valuation can still be justified.
Yes, Lisa, it's a very good question. So you look at the factory of Tesla and you analyze it, and you analyze, its economics, its operating model. It's a chip factory. It's like the economics of a Tesla factory are similar to the economics actually of a TSMC factory. It's very high return on operating assets. It's very, very efficient marketing, a lot of very, very high speed innovation. So from that perspective, Tesla is definitely not a car manufacturer, and that's the reason why we think Tesla can actually grow much faster than the traditional car market, because they basically replace, it's like the smartphone, 10 years ago replacing the mobile phone, but the Tesla type car that is driving fairly autonomously, that is running on a battery, and that offers a very different driving experience, are progressively replacing traditional cars based on IC and with less technology. So from that perspective, it's not a car company. Now, unfortunately, the way we human behave in the car market is affecting Tesla. And buying a car is a very big one-off decision. It has always been very volatile on short cycles. The car industry adapted to that over decades and decades with a distribution operation, a distribution model that absorbs these short-term variations in demand. Tesla doesn't have that. Tesla goes straight into the market from a website and gets hits. And so it's a tough wake-up call, and it's a tough learning even this quarter. But it reminds us that, yes, Tesla is can potentially be very, very volatile in terms of delivery, and that's what's happening today.
Pierre, we also love to get your reaction from the earthquake that hit Taiwan. We understand TSMC is moving staff out of certain areas. They're still assessing the impact of the production. What do you make of this?
Yes, so no significant damage. We were on the phone with Taiwan earlier today, and it looks like there is no significant damage like asset losses related to the earthquake. There is the situation, of course, is still risky with the risk of aftershocks. But so far, you haven't had damages to the assets, which is very good news. So there isn't like a structural change in the production capacity of Taiwan or anything like that. Now, there are factories that have been evacuated for safety. And most importantly, as you were referring to, there are some steps in the process of manufacturing chips where you're positioning things by the nanometer. And so if the earth is shaking, even if it's like 50 kilometers away from you, this is messing up that step of the process. And the wafer that was in the tool being printed or being annealed, for instance, can be thrown away. The wafer is destroyed and it's not going to work. So there are going to be some short-term production impact. So you will probably see in weeks to come some companies explaining that they don't have enough supply, but it's going to be a matter, in leading-edge manufacturing, you count like cycle times in weeks, in a few weeks. If you add to that a bit of disruption in the supply chain, it could extend maybe to 1 or 2 months, but it's going to be a relatively short-lived production disruption, but the fabs are still there. Now, what's very interesting here is that it's another big wake-up call for us, which is like we all rely on fabs that are sitting in Taiwan, and the situation could have been much, much worse, and we could have lost production capacity. And if we are losing production capacity, we would be back into an after-COVID kind of situation where the whole economy is struggling to find chips. And I would relate that to what Intel did yesterday. Intel presented their new, like the implementation of their IDM 2.0 strategy, creating like a fully fledged foundry. And then TSMC also earlier this week announced that their fab, they had line of sight on the first wafers coming out of their fab in the US. So what I find very interesting is that, yes, today Taiwan was hit by an earthquake. It's a tragedy, and I feel terrible for them. But it's happening at a point in time where actually the regionalization of leading-edge manufacturing is actually just taking off. And it was almost a decade in the making. It's very, very slow to get the first Taiwan semiconductor fab in the US, but we almost have it. It's almost done. It took like half a decade for Intel to turn around, reorganize itself, and become a foundry, but it's almost done. So, which means that it's still going to take 5 to 10 years for these businesses to really scale and really become significant share of production, and similar things happen in Japan. But I think we are with this earthquake entering, and of course the earthquake is going to help people remain very motivated to make that happen. But we are now going to see leading edge manufacturing getting more regionalized, and that's good for us. That's good for everybody.
Hey, Pierre, appreciate the insight. Valuable stuff this morning, as always. Pierre Fadiga there of New Street Research, Taiwan Semi, a little bit softer in today's session. Up next on the program, 3 rate cuts still on the table.
3 rate cuts is a projection, and a projection is not a promise. But we have more work to do before I'm confident that on that path.
That conversation up next.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio, and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg.
Two-day losing streak so far this quarter. Equity futures negative by another 0.2%, threatening to make that day three. Yields are higher by a single basis point, 436.52. Under surveillance this morning, 3 rate cuts still on the table.
3 rate cuts is a projection, and a projection is not a promise. If I look at my projection and I say, well, what if inflation's stickier? We may want to cut less. What if the labor market starts to falter or inflation comes down more rapidly? Well, then we might be in a position where we would think cutting more is appropriate. With a projection of 3 interest rate cuts, that still seems reasonable, but we have more work to do before I'm confident that on that path.
Here's the latest this morning. Fed Presidents Daly and Mester urging patience ahead of comments from Chairman Powell later on today and US payrolls on Friday. Jim Moak of AXA saying this: market expectations at 170 makes sense. The pay print will be crucial as long as it's not too far from 4% in the 3-month annualized terms. It's okay given the strength of productivity to keep us towards 2% inflation and to keep Powell on the dovish side. Jill, I'm pleased to say, joins us now. Jill, that's the Fed. That's the market backdrop in the United States. I actually want to start with Europe. The inflation data we got earlier this morning, and the question that I had earlier on, as soon as it dropped, why aren't they cutting interest rates already in Frankfurt, Germany?
But they will. I think they will cut in June. There might be some members calling for an early move, but I don't think it really matters. You know, the direction of travel is now increasingly clear to everyone on this side of the pond. And the hawks may still be able to say, look, even if we've had another good print for inflation today, well, you have this resilience in services prices, which keep us a bit on our toes. So there's probably enough there for the hawks to continue to want a bit of delay in the reaction, even if, again, and it's clear to everyone where they're going to go. And it's already quite a significant shift, I would say, in tone from the ECB in just 2 to 3 months. So, okay, maybe June is a bit too late. In the great scheme of things, I don't think that moving it forward by just one meeting would make a hell of a difference.
Gilles, it does make a question, though, here of how much of a cycle this is going to be. People questioning whether the Fed could potentially cut rates once and then be done for the rest of this year. For the ECB, do they care if they're cutting much more aggressively than the Federal Reserve? Is that kind of weighing on them in this calculus?
Actually, Christine Lagarde was explicitly asked about this, and her answer was unambiguous. They will do whatever is needed considering the conditions in the Eurozone. The only thing which would make them think twice about decoupling from the Fed would be if we had an issue with the exchange rate. But I would certainly argue that at this point in time, even if cutting faster than the Fed could trigger a further depreciation of the euro, it would be okay from an inflation point of view, because the root source of the resilience in prices we have in Europe right now is not on the outside. It's domestic. It's services inflation. the price of manufactured goods, which are massively imported, continues to go in the right direction. So we could probably take a bit of currency depreciation without adding too much in terms of inflationary pressure. So that is the usual conduit. And I would say in the current configuration, there's not enough concern on the FX side to stay in the hand of the ECB. If they think they need to cut, they will. And I don't think they will wait for the Fed. In any case, in June, they have to make the decisions ahead of the Fed. So it will be a leap of faith anyway for them.
Jill, you make a broader point here about currency and the potential for weakness to be viewed as a good thing by certain governments, especially as we do see this incredible ramping up of competition on the industrial side of things. Do you think that, in a sense, there could be a race to the bottom with respect to weakening different nations' currencies to try to be more competitive on the international stage at a time where the U.S. and China both are trying to ramp up industrial production?
Yeah, that's a risk, especially if we have another dose of protectionist measures going from the US after November. I mean, I think we need to take this seriously. If we end up with more US tariffs on imported products, one temptation, a very natural temptation for other countries would be to allow the currency to depreciate. And during the first trade war under the first mandate of Donald Trump, China did not actually depreciate its currency that much. There was a bit of depreciation, but it was not significant. This time around, especially if we talk about tariffs being hiked to 60% from 25%, it will be a big temptation for China to use the currency, especially in a situation in which actually domestic demand would probably benefit from a looser monetary policy. That's a very different situation from where we were back in 2018. So there's no conflict of objectives in a way for China between the domestic and the external objectives when it comes to lose the monetary policy and allow the currency to depreciate. The question then would be for Europe. We are already increasingly nervous at competition of Chinese products on a number of strategic sectors, for instance, the car industry. If on top of everything else we have further depreciation from China to deal with protectionist measures in the US, then there could be, as an after effect, a temptation in Europe as well to allow its currency to depreciate. We do not have as much control on our currency as China. We do not manage the exchange rate. But it would be another reason for the ECB to run a monetary policy that would be significantly looser than the Fed's to allow actually some depreciation of the currency to help us on the external side.
Fascinating. Jill, thank you, sir. Jill Moak there of AXA Investment Managers. Deeply thoughtful stuff on foreign exchange at the end.
Especially paired with geopolitical policy and this idea of the industrial production, the competition that's ramping up.
Does that mean Chinese officials start buying treasuries again?
That means that they can cut rates to zero.
And have a fist,
Yeah, something like that.
Coming up next, Eric Val of T. Rowe Price, Ed Morse of Hartree Partners, former White House fellow Elliot Ackerman, and Michael Collins of PGIM Fixed Income. That and a whole lot more. The second hour of Bloomberg Surveillance up next.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
They're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Pockets of the economy where you've certainly seen the impact of higher rates.
We're generally playing duration from the long side, much more comfortable in the short to intermediate end of the curve.
The overall trend in inflation is still going in the right direction, and that's the strongest argument for extending duration in the bond market.
These inverted yield curves that we've been watching for the last 2 years, those may become positively sloped again.
There's a material risk of substantially higher rates at the back end of the curve, and we could retest the 5% level at some point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Q2 is beginning very quickly. From New York City this morning, good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. With a bit of weakness in the equity market over the last 2 days, make it day 3. Equity futures on the S&P negative by 0.2%, and some key levels being broken in the bond market too. So let's discuss it. New highs for the year on a 10-year maturity, on a 30 maturity. We are through 450. On a 30-year yield, we are through 430. A clean break of that in the last couple of days on a 10-year.
You set that up perfectly. This question of whether a sell-off in bonds is actually good news for equities, which was the theme of the first quarter. It really speaks to strength. Second quarter starting off with, wait a second, maybe not so fast. Maybe this is a little bit concerning.
We've been talking about Fed officials throughout this morning. We heard from Mary Daly, the San Francisco Fed president. Base case for her still apparently something like 3 cuts. 3 months ago, 3 cuts sounded pretty hawkish relative to expectations. And now I have to say, and I said it earlier this morning, now it sounds really dovish relative to how much the market has moved over the last quarter.
And how much the others in the FOMC have moved. Others who are talking about, well, there's no rush. And Raphael Bostic saying 3 last year now, maybe 1 will be enough. I will say what Laureata Messer, though, said yesterday, quote, it's a close call on whether fewer will be needed. That's where we are. Maybe we're going to pencil in 3, but fewer may be needed, and that's what the markets are looking at. But I also want to know from Jay Powell today, will he lean into the labor market or inflation? Jolts yesterday still show pretty tight labor market, but the inflation data we've seen since we last heard from him, whether it's ISM, the uptick in commodities, is that a cause for concern?
Chairman Powell later on this afternoon, I can tell you the first thing I did this morning, I looked at bonds. The second thing I did this morning, I looked at commodities. Brent crude right now up by 0.6%, getting closer and closer to 90, 89.50 on WTI through 85 in the last day or so, 85.70 right now, Lisa, up by 0.6%.
It was remarkable to me that yesterday people were attributing the rally in commodities and in crude as well to demand. And this to me was interesting because a lot of people are talking about possible supply disruptions and what's going on between Iran and Israel. But this is something more with respect to just the slowly tick-by-tick rise in commodities. Taking a bigger picture, we talk about the industrial production wars that we were just talking with Gilles Moek about, how much that fuels the commodity sector in a new way. that is sort of a theme that we keep hearing with Jay Pulaski basically saying, it's demand, people, go to it.
Is that your Jay Pulaski impression?
Well, I mean, that's sort of what
Jay,
he
if
was
you're
saying.
watching, I'm sorry.
Sorry, Jay. But that's sort of, what people are saying out there.
The issue I have is this temporary, or is this going to be for the rest of the year? Because even when Bank of America this morning came out and upgraded what they see for Brent and WTI, they see the peak happening this summer, peak driving season. And politically, of course, you're not going to be looking at whether or not the U.S. decides to hit another SPR.
Do you want to do that again? Or you're done?
I think I'm done. Okay. Jay, I'll send you flowers. I'm so sorry. But, I I just got emotional, and it really inspired me.
I'm waiting for the emails from Jay. Emotional because he's so bullish.
Just because he's just trying to do straight talk.
Okay.
Stop looking at the Magnificent Seven frou-frou.
Sure.
It's going beyond. It's going big. He's into China. I'm curious about how that trade's going.
Yeah.
Anyway, I'd be curious.
Let's talk about stocks right now. Equity futures on the S&P 500. Negative again, but no drama with this move. Just a small move, a mild move lower of 0.15% on the S&P. Yields a little bit higher by a single basis point, 436.12 on a 10-year. Coming up this hour, we'll catch up with Eric Vahl of T. Rowe Price as fading rate cut bets send stocks lower. Ed Morse of Hartree with Brent crude closing in on $90 a barrel. And Michael Collins of PGIM on the sell-off in US Treasuries. We begin with our top story. Good news is apparently bad news now. Better than expected economic data pushing out rate cut bets and sparking a sell-off in markets, setting the stage for comments from Chair Powell later on today. And the US jobs report on Friday. Joining us to discuss is Eric Vahl, the CIO and head of global investments at T. Rowe Price. Eric, good morning to you, sir.
Good morning.
Let's just talk about Chairman Powell a little bit later. Have your expectations for the Federal Reserve this year shifted in quite the same way market expectations have?
We were never as excited about as many rate cuts as the Fed had, as the market had priced in. I think one of the things that really stands out to me is if you go back to what Powell said very early on, he was a student of what happened in the 70s. And if you go back and you look at the mistake made then, it was cutting too early. And if you map the CPI to the very beginning of this cycle versus the last, it's following a similar curve. And if they go ahead and they start cutting now, I think they're in danger of making the same mistakes.
Do you perceive that as the biggest risk then, cutting too soon and not holding too long?
I do.
What would that mean for bond markets if they did?
Well, I think you would see what would happen is the spike up, and then you would have to react to that in a way that would put them on their back foot. And that would lose credibility, and you would have a big issue for them.
I want to challenge one thing that you said, which is that Powell is a student of the 70s. Is he really? Because right now he sounds pretty much like the most dovish member on the FOMC. It sounds like he really wants to cut rates. And frankly, a lot of people are looking at that as the reason to buy stocks. Are you saying that they have it wrong?
No, I'm not saying that they have it wrong. I do think he is a student of history, and what he has to do is keep that group, find the middle ground between that group and present it in a way that presents consensus broadly within that committee and balance out the other speakers. So I think he's very much trying to do that right now. But again, I think as you look at the next several months, the idea of cutting when we are where we are from an economic perspective just doesn't, I think, make a ton of sense right now.
Which raises this question, if you do think that this inflation is stickier, and you think that the risk of a 70s type of scenario is greater than the risk of some sort of unforeseen downturn, do you just buy commodities, buy stocks, avoid bonds at all costs? Because right now it's not clear that this FOMC has the conviction to really make the right call and not have a policy error.
Well, I wouldn't go that extreme, right? So as we've unfortunately or fortunately said, we're right now in our asset allocation committee, we're actually dramatically neutral is the phrase that we've been using between stocks and bonds, which is not the most exciting fodder for the media, but that's where we are. I do think commodities, though, is really interesting. And so we are, within our equity portfolios, we're overweight energy in the vast majority of those and in different ways. And we think there are some really interesting opportunities there coming from our bottoms-up work.
Going back to Powell and a student of the 70s, does the commodity pressure, you think, and the increase we've seen unnerve him? Because we heard him say that he can cut quickly if they see labor market deterioration. But you're saying he's really leaning on inflation more than he is the labor market.
Look, I can't tell you I know what's in his head. I do think, though, that in the inflation numbers that we've seen have to give you some pause, right? Just as a reasonable place to be. If you were him, what would you do, right? And I think you have to look at that data.
Do you think we have seen a regime shift post-pandemic versus pre-pandemic? And if you do, how is investing in the next decade or so going to change relative to the previous decade?
Without a doubt, we have seen a regime shift post-pandemic. And the issue is all about the absolute low rates that we had heading prior to the pandemic, where it was much more about the macro, right? It was much more about all things up when a zero environment, risk assets on. In this environment at higher levels, you have to be more, it's much more of a bottoms-up world from our perspective, and it's not as easy in just a chase.
Well, let's get into that because it feels like everything is up so far this year. What shouldn't be up?
Interesting question. What shouldn't